So now let's start with the revision of the third chapter in this marathon, which is capital structure decisions. Now, what is this chapter all about? Now, in financial management, as we already know, this subject has three objectives. What are the three objectives of our subject? Financing decisions, then investment decisions, and then dividend decisions, right? Financing decision means what? Taking decisions which with respect to the fundraising activity, correct? Yes. Investment decision means what? Taking decisions with respect to where the funds need to be invested, whether I should put it in project A or in project B or in project C and so on. And dividend decision stands for what? It stands for how much of my profit needs to be paid as dividend and how much needs to be retained with the company, right? Now this chapter, capital structure, comes under the first category, that is financing decision. Now, sir, before that, first, what do you mean by a capital structure? What do you mean by a capital structure? Capital structure is nothing but the components of every single source of finance. So, capital structure is nothing but the components of different sources of finance. For example, let us say in situation one, okay, so equity share capital, preference share capital, and debentures. Just an example. Let's say the first scenario, or let us say this is A limited. Okay, let's take this as A limited. I'm taking this as A limited. A limited has raised a total of how much? Let us say 100 crores. Okay, and the entire 100 crores they have raised from equity share capital. Are you clear with this? No preference, no debt. Let's say B limited is there. They have also raised a total of 100 crores. But for B limited, if you see, they have raised 60 crores from equity share capital, then 30 crores from preference share capital, 10 crores from debenture mode. Let us take C limited. C limited, what they have done? C limited, they have raised 50 crores from equity, nothing from preference, and 50 crores from debentures. So overall, they have also raised 100 crores. Or in other words, so how much of equity, how much of preference, and how much of debentures are present inside this capital is called as capital structure. So for A limited, I will say the capital structure is 100 crores entirely from equity. Whereas for B limited, I will say 60 from equity, 30 from preference, 10 from debentures. And for C limited, it will be 50, nil, and 50, and so on. So the capital structure means the manner or the source from which I have raised funds. So how have I raised this funds? This entire 100 crores, give me the breakup from which source we have raised what? That is called as capital structure. And in this chapter, we are going to see which is the best source of capital structure, which is the optimum capital structure. That is, I want 100 crores. Money is money. Yes, I want 100 crores. But should I raise this entire money from equity? Or should I raise 60 from equity, 30 from preference, and 10 from debt? Or 50 from equity, 50 from debt? Sir, which is beneficial for me? How do I find out? So this decision is called as capital structure decision. Are you clear with this? And this is what we are going to see in this particular chapter. This is number one. Number two, one very important thing that we need to see in this chapter is that the first part of this chapter talks about general areas. It says, how do I choose the best capital structure? Capital structure means what? The mix or the proportions of different sources of capital, which is beneficial entirely from equity or partly from equity, partly from preference, partly from debt, or equity and debt. Which mix is best? If so, how much should be the mix? All this is what we are going to take the decision here. Now, how do we choose? Which is the best source of finance? How do we select which is the best source of finance? So the decision of selecting the best source of finance can be taken on the basis of following. You can take this decision on the basis of return on equity. You can take this on the basis of market price per share. You can take this on the basis of earnings price per share. So what is this? What are you saying? Now, broadly, there are three parameters. It goes on, right? So what we have seen here, what are the three parameters that we have seen here? So first, you can take it on the basis of return on equity. Fine. The second was from the basis of what? Market price per share. And the third was on the basis of earnings price per share. Sir, what is it? Now, for each of these three capital structures, okay, for these three capital structures, overall, what is the fund raised? 100 crores. But because of where I am raising these funds, because of this, my overall return on equity can change. Yes or no? Return on equity is nothing but what? Earnings for equity divided by equity shareholders funds. Correct or not? Yes, equity shareholders funds. So basically, this is nothing but how much amount is earned by the equity shareholders divided by how much they have given you as a capital. Correct? So now, if you are going as per this method, so for each of these three capital structures, calculate the return on equity and go for that alternative that gives you the maximum return on equity. That is called as return on equity approach. No, sir, I want to look at it from the perspective of market price per share. Then what you can do is for each of these three capital structures, calculate the market price per share and go for that alternative that gives the maximum price per share. No, sir, I want to go based on EPS. Compute the EPS for each of these three alternatives and go for that alternative that gives you the maximum EPS. Now, you might be having a doubt. Sir, if I go based on return on equity, they are saying, just an example, I'm just giving you an example. Fine. If I go based on return on equity, they are saying this is the ranking that I'm getting 1, 2, and 3. That is return on equity is maximum for A limited. Correct? And number 2, it is next comes B limited and next comes C limited. Sir, but if I go as per market price per share, so what is happening? So C limited, that is the third alternative, gives the maximum price per share, followed by let us say A limited, and finally this B limited comes in. Are you clear with this? Now, if you go as per EPS, if you see as per EPS, what happens? The first alternative gives the least EPS, correct? The second alternative gives the topmost EPS, and the third alternative gives the second EPS. Or in other words, if you go as per return on equity, the best source of finance is all equity. Whereas if I go based on market price per share, it says that the third alternative is the best capital structure. Whereas if I go based on EPS, then the second alternative seems to be the best alternative. Sir, there is a conflict in rankings. So of these three methods, which is the best? So there is nothing like which is the best. It is just three different parameters based on which you can judge. I will give you one small example. Now, is share market, investing in share market, is it good or bad? Is investing in share market good or bad? Now, let us say I am asking you this question. Investing in share market, is it good or bad? You are saying it is, sir, very good, sir. Why? Because if you invest in share market, you will get more returns. Fine. Now, I am going and asking the same question to your grandfather. Okay, assume I'm asking the same question to your grandfather. I'm asking him, is investing in share market good or bad? He says it is definitely bad. I would rather put all my money in my FD. I will not invest in share market. If you ask him why, he will say because in share market the risk is more, whereas in FD and all there is not much of risk. Or in other words, from a risk perspective, FD seems to be good. From a return perspective, share market seems to be good. Now, you tell me, FD is better or your market is better, share market is better. There is no one conclusion to this. If you look at it from the perspective of risk, FD seems better. If you look at it from the perspective of your return, then your share market seems to be better. Similarly, there can be conflict in rankings based on the method that you pick. If you pick based on return on equity, maybe one alternative will be the best. Based on MPS, market price per share, it might give another alternative as the best result. Are you clear with this? So don't compare these three. Don't compare these three methods of finding out which is the best structure, capital structure. Are you clear with this? Yes. So you just leave it there. So that's why the subject is open-ended with respect to this. If you go as per return on equity, I will choose the first alternative in this example, just an example. If you go as per the market price per share, I will go with the third alternative. If you go as per EPS, I will go with the second alternative. And that's all. You should leave it there. You cannot say of these three overall, only the first alternative is better or second alternative better. No. From the perspective of return on equity, maybe one alternative is better. From the perspective of market price per share, another alternative may be better. And from the perspective of EPS, another alternative may be better. We don't know. Maybe it might even match. All the three might even show that the alternative one is better. We don't know. But what I'm trying to say is, please don't compare between these three methods, because these are three different perspectives of looking at the same situation. Are you clear with this? This is exactly same as what I was telling you. Is share market good or bad? From a risk perspective, it is bad. From a return perspective, it is good. Now you decide. If you are a risk taking person, that is, I am not bothered about risk, sir, I am only focused on return, then you will go for share market. You are a person who feels, no, I don't want more money, my objective is to not lose the money that I currently have, then you are a risk averse person. You don't want to take risk. From the perspective of risk, you will say share market is bad and you will go for FD. So there is no one single answer. Sir, is share market good or bad? No, it is good as well as bad. It depends on the perspective from which you look at it. Are you clear with this? This is again a place where many students get confused. So of these three capital structures, which is better, sir? No, there is no one size fits for all answer here. There is no ready-made answer. You should look at from the perspective of return on equity, one might be better, and from the perspective of MPS, one may be better, and from the perspective of EPS, another may be better. Are you clear with this? Yes. So this is what we will be discussing in the general part of the discussion. Then there is the second part to this particular chapter, which is the most important part and supposedly the complicated part for many students. In my past interaction with students, I've seen that they struggle in this particular part of this chapter, which is called as capital structure theories. It is called as capital structure theories. In capital structure theories, we will be seeing that a total of 4 theories we will be seeing. So now, please don't think that theory means what? Don't think that theory means, now law paper is theory, FM paper is practical. So theory means what? Basically what we think is, now theory means if there are only words without any practical numbers and all, we call it as a theory area. No. Theory is not that. Theory is basically, the real meaning of theory is idea or one person's perspective. So capital structure theory means what? There are 4 people. There are 4 different people, human beings. There are 4 different economists. They have given their perspectives. They have given their perspectives on choosing the best capital structure, and we are going to read it. For example, net income approach was given by a guy called David Durant. Okay. So from his perspective, what he says is what we are going to read. So this is fully a practical area. There will be numerical problems. So don't think we are going to see some theory area. That's why I'm saying there's a misunderstanding. Theory doesn't mean only words. No, that is what generally CA students generally think. Theory subject, practical subject. That theory you don't apply here. Are you clear with this? Theory means a perspective. So here, net income approach. This particular approach is given by one guy, and we will be seeing what is his approach. He will be saying that, see, these are the assumptions based on which I am choosing the best capital structure. Fine. Net operating income is another approach which is given by another person. Traditional approach is given by another person. And Modigliani and Miller, approach, this is also given by one more individual. Are you clear with this? So broadly, we will be seeing what each of these 4 capital structure theories are saying. They are quite distinctive, and what they are is what we'll be seeing in the second part of the discussion in this particular chapter. So this is the overview of this particular chapter. So let's get started with the first part of it. So the first part of it, in this segment, we'll find out the best alternative source to fund a business. Alternative source could be what? Equity, or equity plus debt, or equity plus debt plus preference, maybe in different mix, different proportions. And this is called as capital structure, which is the best capital structure. That is what we need to find out from different perspectives. We can find out. The following are the various sources of finance for an entity: equity share capital, retained earnings, preference share capital, debentures, long-term loans. Money or funds can be raised from one or more sources, and it requires careful decision making. And how will you take the decision? The decision of selecting the best source of finance can be taken on the basis of return on equity, MPS, EPS, etc. Are you clear with this? So from each perspective, there could be a different ranking. That is fine. That's why I said the subject is open-ended. You cannot say of all these things, only one is better. No, nothing of that sort is there. Are you clear with this? From the perspective of ROE, maybe one particular capital structure might be better, or one alternative might be better. As simple as that. Now, one more thing. Now, in this case, what happens? Look, A Limited. So let me just take this up. 1 second. So I'll just rewrite it here. Right. So now we have three sources, or we have, let us say, three alternative sources of funding our business. Okay, I will call this as alternative one. I will call this as alternative number two. I will call this as alternative number three. See, basically, the company needs how much? 100 crores. Money is money. Correct. I need it for what? To invest in my multiple projects. Which project to invest? That comes under investment decisions. Fine. That is the next chapter that we are going to see. But right now, I need 100 crores. Yes, fine. I will arrange. But that 100 crores, from where I should raise, is the decision that we are taking in this chapter. It could be entirely from equity, or partly from equity, partly from preference, partly from debt, or partly from equity and partly from debt. In whichever manner you want, you can do it. Correct or not? Maybe there could be an alternative for partly from equity and partly from preference, 50-50, and zero from debt. It could be anything, right? Now, of these three alternatives, in this case, I'm giving you three alternatives. Don't think that there are only three alternatives. There could be any number of alternatives. So now, out of these three alternatives, which is the best? That decision we will be taking based on multiple parameters like ROC, return on equity, your market price per share, and earnings per share. Now, but before that, you should understand one thing. EBIT stands for what? EBIT stands for earnings before interest and tax. And earnings before interest and tax will be the same for all these three alternatives. Sir, what you are saying, or in other words, EBIT will not change because of the capital structure. Or in other words, this overall is 100 crore rupees. For 100 crore rupees, the EBIT will be the same, irrespective of where you have raised this 100 crore rupees from. Sir, 100 crores, I have raised it from equity or partly from equity, debt, and preference. Still, EBIT will be the same. Why, sir? Because EBIT is nothing but what? Operating profit. How did you arrive at EBIT? Recall our income statement. Sales minus variable cost gives you what? Contribution, minus fixed operating cost gives you EBIT. Correct. And from here, minus interest gives you EBT. Then minus tax gives you EAT. Correct. Minus preference dividend gives you earnings for equity. Correct. Yes, earnings for equity, and divide by number of equity shares, you get what? You get your EPS. Correct or not? Yes. So basically, now overall in all these three scenarios, how much amount I have invested into the business? 100 crores. And till my EBIT level, it is all relating to my operating activities. There is nothing concerning my financing activities. Correct? Or in other words, this is the costing area. Correct. Overall in this business, I have invested how much? 100 crore rupees. So using this 100 crore rupees, whatever sales minus variable cost, fixed cost, whatever I get, that is the EBIT. Or in other words, EBIT for all the alternatives having an overall same capital will be the same. Only after EBIT, things will change because of your capital structure. Are you clear with this? So basically, now in this case, in the first alternative, if you see, there is only equity. Correct. So in this case, there will not be any interest, there will not be any preference dividend. Correct. Whereas if you see in the second case, you have both the preference as well as debentures. So the second alternative, there will be interest, there will be preference dividend. So finally, the earnings for equity and the EPS might change. Are you clear with this? And similarly, the third one, you have only equity and debentures. So basically what you have, you will be having only interest, but you will not be having any kind of preference dividend. So basically your capital structure, that is the source of finance, will affect your profit only after your EBIT, or till your EBIT. There is no change in your capital, there is no change in your profit because of the source of finance. Are you clear with this? So your source of finance will not impact your EBIT. Your source of finance will impact only the items that are coming after the EBIT. Are you clear with this? In these three scenarios, overall in my business, I have deployed 100 crore rupees. Using that, I've generated sales and I've made operations. So all the three sources will start with the same EBIT. Are you clear with this? From there only things might change. In alternative 1, there is no interest dividend. In alternative 2, interest dividend both are there. In alternative 3, only interest is there. There is no preference dividend. So this can change only after the EBIT. Are you clear with this? So first thing to understand is that EBIT will not change based on your source of finance. That is, capital structure, which is a source of finance, will not impact your EBIT. It will only impact your components that come after the EBIT. Fine. This is a very, very important thing that you need to understand. Now, with this, let's directly jump into one question and let's quickly finish it off. So please take the first question. Now, a company needs 31,25,000 rupees for construction of a new plant. The following three plans are feasible. The company may issue 3,12,500 equity shares of 10 rupees per share, or the company may issue 1,56,250 ordinary equity shares at 10 rupees per share and 15,625 debentures of 100 rupees denomination bearing an interest rate of 8%. Or third alternative, the company may issue 156,250 equity shares of 10 and 15,625 preference shares of 100 each bearing a dividend of 8%, right? So basically what they are saying, let me go to this question number 1. So in this first question, what they are saying, overall the company wants how much? 31,25,000, and they are proposing three alternatives. What are the three alternatives? Equity share capital, yes, preference share capital, and your debentures. In all the three cases, what they are suggesting is the amount they need is 31.25 lakhs. Correct? Lakhs of crores. It is 31 lakh 25,000, 31.25 lakhs, 31.25 lakhs. In all these three scenarios, overall amount that they are raising is 31.25 lakhs. There is no change in this. But the first alternative says it is entirely raised through the equity channel. That is, the entire 31.25 lakhs comes from equity, zero preference and zero debentures. Next. The second alternative says 1,56,250 shares at the rate of 10 each, or in other words, 1,15,000. So this is going to be 1,56,250, right? So this is going to be 15,62,500. So 15,62,500 rupees should be raised from equity, and then what they are saying, the balance 15,625 debentures with 100 denomination into 100. So the balance 15,62,500 rupees should be raised by way of what? Should be raised by way of debt mode. So they are saying 8% debt, you raise the remaining amount of 15,62,500, and nothing should be raised from preference. And the third alternative, what they are saying, balance 50-50 from equity and preference. That is 15,62,500 from equity, 15,62,500 from debt, from preference, and zero from debt. Are you clear with this? So overall, the company wants to raise how much? 31,25,000. Here, the question is not about how much amount to raise. The question is about how to raise this amount. Are you clear with this? So whether to entirely raise it from the equity channel, or equity and debt channel, or equity and preference channel, which is the best? That is what they are asking. Are you clear with this? Yes, and here they've said preference is also 8%, right? So preference is also 8%. That's what they have given. Yes. Now look at this. Required. If the company's earnings before interest tax are 62,500, 125,000, 2,50,000, 3,75,000, 6,25,000, what are the earnings per share under each of the three financial plans? Assume a corporate income tax of 40%. Which alternative would you recommend and why? So in this question, they are just asking you to calculate EPS. That is, you should decide which is the best source of finance through what? Through EPS. So you will compute the EPS and you will say you will go for that alternative which gives you the maximum EPS. Are you clear with this? But wait, what they have given? They have given 1, 2, 3, 4 and 5 EBIT. If the company's EBIT is 62,500, 1,25,000, 2,50,000, 3,75,000, 6,25,000, what are all these things? Basically, what they are saying is, assume the EBIT is 62,500 rupees. If EBIT is 62,500 rupees, calculate the EPS under each of these three plans. Are you clear with this? Then If your EBIT is 1,25,000 rupees, then once again you recompute the EPS for these three plans. If your EBIT is 2,50,000, once again recompute the EPS for these three plans. So basically what you need to do is you need to compute the EPS for each of these three alternatives under 5 scenarios. So they have given 5 different EBITs. Assume EBIT 62,500 for all the 3 cases, then compute the EPS for 3. Now suppose EBIT is 1,25,000, compute the EPS for 3. So you have 5 scenarios and each has 3 alternatives. Overall, you need to compute EPS 15 times. Are you clear with this? Are you clear with this? It's a very, very comprehensive thing, but it's fairly a simple part, but you should understand what this is. See, the EBIT is not changing because of the alternatives. They are giving you multiple situations. This is like they are giving 5 different questions. Are you clear? Fine. If your EBIT is 62,500, compute the EPS for all 3 alternatives. When my EBIT changes to something else, once again recompute the EPS under all the 3 alternatives. Are you clear with this? And overall, you should give your observation, recommend and why. Which one would you recommend and why? Are you clear with this? Now fairly a simple task, So what we need to do is plan wise we will go. That is, let's say first entirely I'm going 100% equity. I'm going fine. I'm going for 100% equity. So now list down all the 5 alternatives. What are the 5 alternatives that we've got? So 62,500, yes, 1,25,000, 2,50,000, 3,75,000 and 6,25,000. Correct? Now what we are trying to do is alternative wise we are going. Now for this alternative, for alternative 1, what will be the EPS under the 5 different situations mentioned in the question? Similarly, we'll once again do for second. Similarly, once again, we'll do for third. Are you clear with this? That's what we need to do. Now, what is the format of your income statement? Now, I told you, your financing decisions actually impact only, your capital structure decisions impact only after the EBIT, or in other words, your EBIT, till your EBIT, there is no problem. After EBIT only, technically the FM part starts. So EBIT minus interest gives you EBT, minus tax gives you EAT, divided by number of equity shares gives you EPS. Correct or not? In this question, they have asked for EPS. Now, in each of these parameters, this data is given. EBIT minus interest. What is the first alternative? Entire source of finance is through equity. So is there any interest? No. So minus 0,0000. Clear? So you get the EBT, right? Now less taxes at the rate of 40% on EBT. These figures also you will get. Clear with this? So EBT minus taxes gives you what? Earnings after tax. Correct? Now, is there a preference dividend in this area? No preference dividend, because in the first alternative, there is no money raised to the preference channel. So this EAT also becomes what? Earnings for equity. Yes or no? Since the preference dividend is 0. Yes, if you want, you can add one more line, minus preference dividend 0,0000. And then again, you can put earnings for equity, right? Now, divided by number of equity shares. In the first alternative, how many equity shares are there? Now, look at the first alternative here. 3,12,500 equity shares. Correct? So divided by 3,12,500 equity shares. So you will get EPS for each of the 5 different EBITs. Are you clear with this? So for the 5 alternatives, for each of the 5 alternatives, if I am entirely financing it through my equity channel, what will be the EPS? This is what we have found out in the first situation. Correct? Let's not conclude anything. Let's go and see the next one. Let's do the next 2 also, and then finally we will come to a conclusion. Are you clear with this? This is too much of computation driven. Not much of it is not challenging your intellect. Okay, so this is basically very simple to do, but when you're doing it in an exam, it takes some time for you to do all these things. You should be careful with the calculations. So generally students make a mistake in calculations in this area. Beyond that, there is nothing great. Now second, debt equity mix. So what is the second part? Debt equity mix. That is 15,62,500 comes from equity, 15,62,500 comes from 8% debt. Correct? So now what is the format? What is the format of your income statement? So EBIT minus interest gives you EBT, minus taxes gives you EAT. Correct? Now is there a preference dividend here? No. So EAT also is your EFP divided by number of equities give you what? Gives you your EPS. Correct or not? Yes. So now each of these 5 EBIT is given in the question. So under the 5 situations, we need to compute this But remember, we are doing it for debt plus equity mix minus interest. So how much will be the interest? So 15,62,500 is the debenture amount, debt amount, and 8 percentage is the cost interest respect to debt. So 15,62,500 into 0.08 gives you 1,25,000, and that's how we've got this figure of 1,25,000 in all the 5 cases. Are you clear with this? So these are 5 different EBITs for the same plan. This is plan number 2. Are you clear with this? So how much is your EBT? So how much is your EBT? So in this case, 62,500 rupees is your EBIT, correct? Minus 1,25,000 is going to be your interest. So EBT will be what? Minus 62,500. Can EBT be negative? Yes, it can be negative. You have made a profit of 62,500 only. So then 1,25,000 is my interest, sir. Where from the company will pay? Maybe previous year's retained earnings you pay, or you once again borrow to pay this. We don't know. But interest needs to be obligated. It is an obligation that needs to be paid, correct? So this makes your EBT negative, correct or not? Now, very important, very important. Now, when I have a loss, should I pay any tax? No. Income tax is a percentage on EBT, correct? Sir, when there is a loss, will I pay any income tax? No. Correct. But remember one thing, if you have losses, I can set this off in the future years, correct or not? Or in other words, let's say this company is doing many business. From one particular business, they are making this loss. Can it be set off against the profit made by the same company from another business? Yes. Or in other words, because of this loss, there can be a tax saving, yes or no? Why? Because the losses can be set off against the profits from another business of the same company, or it can be set off in the future years also. Or in other words, because of this loss, there is actually some tax saving for me. There is a benefit for me, correct? This is a pain, correct? I'm incurring a loss, but in that pain, there is a gain for me. Yes, there is actually some tax saved here. Are you clear with this? Understand? So this reduces minus 62,500 plus 25,000 becomes minus 37,500 is your earnings after tax. Are you clear with this? So basically your loss will reduce because of the tax saving component. In this case, taxes will be added. It is not tax paid, it is tax saved. Are you clear with this? And this is where they have written a note here. The company will be able to set off the losses against other profits. Are you clear with this? So this is an income tax concept. Yes, there is something called as Chapter 6 of the Income Tax Act, not the Chapter 6 of whatever material that you follow. No, the income tax itself has many chapters. Law is divided into chapters and sections. So there is Chapter 6 called a set off and carry forward of losses that talks about this. So a loss of a particular entity, a loss of a particular business can be set off against the profit of another business of the same assessee, of the same company, correct? Or maybe if you don't have any other business, this is the only business, you can carry it forward, and in the next year if you are making a profit, you can set off, correct? And only to that extent you need to pay tax. So basically to the extent of this loss, you need not pay taxes, correct? So there is a tax saving because of the loss. So there is a pain, in that there is a gain. Are you clear with this? That's why we are adding it back and making it as. So now our earnings after tax will actually show a lesser loss. Are you clear? So this is a better off situation. Are you clear with this? Very important. Students miss this out. What they do is they blindly do. So this is 62,500. Some students, what they do, they think they are very smart. They put it as 0. No, negative loss only, no sir, no tax. Some students, what they do, they calculate 40% on 62,500. This also they make it as negative and they increase the loss further. No. Like that you should not do. This is a tax saving. Are you clear with this? Fine. Similarly, in the other cases, what they have done, EBT is 0. So obviously tax will be 0. So earnings for equity is also 0. Similarly, in all these three cases, here there is a profit. Earnings before tax is a profit. So so you need to subtract 40% of that to arrive at your earnings after tax, which is also your AFP, divided by the number of equity shares. So how many equity shares have been issued here? So look at this, 1,56,250 ordinary equity shares have been issued. So earnings for equity divided by equity shares gives you what? EPS, correct? So in the first scenario, you have a negative EPS. How much? Minus 0.24. Can there be a negative EPS? Yes, absolutely there can be a negative EPS. When your earnings per equity is negative, yes, you can have it. Clear? In the second scenario, it's 0. The third scenario, it's 0.48. Fourth scenario, it's 0.96. And the fifth scenario is going to be 1.92. Are you clear with this? Yes. Now, once again, we need to recompute all these things for the third plan, which is what? Equity plus preference mix. What is this equity plus preference mix? This is 15,62,500 from equity, 15,62,500 from preference, and there's going to be 8% preference. Remember that. So now, EBIT, so 5 different scenarios. How do we know these figures? It is given in the question. Correct? Less interest, no amount from debt, 0 only. So directly you get your EBT. From this, you less your taxes, you get what? Your EAT. Correct? From that, you less your preference dividend. Preference dividend, how much is it? So it is going to be 8% on 15,62,500. That is going to be 1,25,000. You reduce it, you get how much? You get your profit after tax, that is earnings after tax, or it is also known as earnings per equity shareholders. So you get minus 87,500, minus 50,000, 25,000, 1 lakh, and 2,50,000. Divide this by number of equity shares. So how much is the number of equity shares with the third alternative? Third alternative has how many equity shares? So 1,56,250 equity shares. So divided by 1,56,000, respective EFE, earnings per equity, divided by 1,56,250, you get the EPS for each of these alternatives, which is 0.56, 0.32, 1.16, 0.64, and 1.6. Are you clear with this? Are you clear with this? Yes. So now what we have done? So for each plan, for 5 different alternatives, we have calculated 5 different scenarios. We have calculated the EPS. Now, let us come to a conclusion. What are they saying? The choice of financing will depend on the state of economic affairs. So, I'm telling you, this is an open-ended area. Don't say this is the best or this is not good, this is very good. No. Depending on the perspective, things will differ. If the company's sales are increasing, EPS will be maximum under the second plan debt equity mix. You look at this. If I have maximum sales, that is more the sales, more will be your EBIT, correct? So now tell me, in this case, what happens? Your first alternative has an EPS of 1.2. Second alternative has a whopping 1.92. The third alternative has only 1.6. So of the lot, which is better? If I have more sales, then I would go for the second alternative, that is debt and equity mix. And why is this alternative showing more EPS? Because I have debt plus equity, correct? Because of debt, there is some tax saving, leverage effect is happening. Can you connect the two? Are you clear with this? So now leverage is working in my favor, and that is the reason as my sales increases, the magnifying effect is more, and so I am going for my EPS, the earnings per share of the equity shareholders are more in this case. Are you clear with this? Look at this. So under favorable economic conditions means what? You have more sales. So debt financing gives more benefit due to the tax shield or tax saving availability than the equity or preference financing. Also, its EPS is increasing at a rate higher as compared to the other plans. Are you clear with this? So here, look at the rate at which it's increasing. Negative, slowly it's increasing from 0.16, 0.64, 1.6. If you look at the first one, 0.12, slowly 0.24, then 0.48, 0.72, and then 1.2. But if you look at this, yes, the first part is negative, but from here on, look at the rate at which it increases. From till this, it is almost the same with the first plan. Look at this. From here onwards, the first plan gives 0.72. This gives 0.96. From that, this jumps to 1.2. Here it jumps to 1.92. So what they are saying, if the economic conditions are favorable, as you are getting more sales, it is better to. It looks better that the plan number 2 is better. Why? The reason is that your EPS is increasing. And why is the EPS increasing? Because of the leverage effect that happens because of tax savings. Are you clear with this? Yes. So this is the conclusion that you can give. Open-ended conclusion. Don't say this is always the best. Fine. For a favorable economic condition, yes, looks like this is what is the best. Are you clear with this? You just leave it there. Fine, guys. Are you all clear with this? Yes. So now that's about this particular question. Calculation of EPS for 3 plans. Under that, 5 different EBITs were given, and we did that. Are you clear with this? So with this part of the easier part of this chapter is actually over. We have revised the easier part of this chapter. Now let's move into the next part, which is the capital structure theories. Now let's go to the second part of this chapter. where things get little tricky. Now, capital structure theories. Now, in this segment, we will find out the optimum capital structure. Optimum means what? Best. Best alternative of capital structure. Capital structure is source of finance. Which alternative is best? Now, we will find out the best capital structure under the multiple methods or theories of capital structure. That is, we will not look at it from EPS perspective, MPS perspective, return on equity. No, we will look at it from the perspective of four different people who have given their own ideas, their own viewpoints. So strictly, these four theories, capital structure theories that we are going to study are proposed by four different people with their different perspectives. So now, please don't extend your logic here. We are just going to study what these four people have said. That's all we are going to study. And that is what the segment says. Sir, of these four methods or theories of capital structure, which is the best? Nothing of that sort. These are just four different perspectives that people have given. Four different people have given. Now, you cannot say one is superior, the other one is inferior, because each of them make their own logic. In fact, all these things will have their own flaws also. They have the downside also. So please, again, don't compare and say, so there are four methods that we are going to see here. Net income, net operating income, traditional approach, Modigliani-Miller approach. Of these four, which is the best method, sir? No, nothing of that sort. Net income approach, it says, these are the assumptions that I am making. And based on these assumptions, I am saying, this is what will happen. Are you clear with this? And based on this, you can decide. Whereas net operating income says, I am putting some more assumptions, different assumptions. And for my assumptions, I am saying this is the way to choose the best capital structure. So these are completely different. Can you say which is better, monkey or donkey? No, you cannot compare. You can say monkey A or monkey B is better. Yes, you can compare. How can you say whether you like monkey, whether monkey is good or donkey is good or which is better? These are not at all comparable. Similarly, these four are different theories given by four different people. They have said, we have listed some assumptions, and for our assumptions, we are saying, we have done some analysis, some research, and we are giving our hypothesis. We are saying that this is what we have found out in our research. Basically, we are studying four different researches. Are you clear with this? Sir, out of this, which is better? There is no comparison here. Clear with this? Students tend to compare. Please don't compare it. So now, sir, why are we studying this? Honestly, we are studying this because it's a part of your syllabus. That's about it. Because there are multiple ways to gauge it. I just told you how to choose the best capital structure from the perspective of return on equity, or from the perspective of EPS, or from the perspective of MPS. You can do it anyways. It's an open-ended area. Now we are studying what these four different theories are stated by four different people. We are just studying what these guys have researched. As simple as that. So please don't bring your logic into this. We are just seeing whatever is the logic they have given for the assumption that they have given, and whatever is the findings that they have made. That's all we are going to see. Are you clear with this? Students generally make a mistake here. They think, sir, this doesn't seem logical. Fine, it is not logical, but that man says that. You just need to study it. That's about it. Are you clear with this? Are you clear with this? So don't extend your logic. We are just going to see what these four people have said in their own researches. Are you clear with this? And that is called as theory, their research, their perspective, their viewpoint. So these are some alternative words. Don't think it's theory means writing something in words. No, that is not theory. Are you clear with this? Yes. Now, there are certain things in common. There are certain things in common that all these four methods say. Optimum capital structure must have the following features. So first, let us see all the commonalities in this area, and then we will enter into one by one. Now, what they are saying is the optimum capital structure, that is the best capital structure, must have the following features. Number one, the value of the firm. Firm means what? Company. The value of the company should be maximum. And the cost of capital should be minimum. This is something that all these people are saying. What they are saying, the best capital structure is the one that has the maximum value and minimum cost. Value of firm is popularly known as VF, correct? And cost of capital is known as KO. We have seen it in a previous chapter, correct or not? Yes. So they are saying the best alternative course of source of finance is the one that gives you the highest value of firm and gives you the least cost of capital. Are you clear with this? Yes. Now, for the purpose of this four capital structure theories that we are going to study, now there are a few assumptions. Now we are going to study. Now, don't question these assumptions, please. Please don't question these assumptions. These are the assumptions based on which they have done the research. That's all. Sir, why they have assumed like this, I don't know. We should only dig their grave and ask these people, because these guys are like, they are no more. Fine, they are like elderly people. So they have done this so many years back. So we cannot do anything about it. For the assumptions, they have given their research. What we are doing, we are studying. Why we are doing it? Because it's a part of our syllabus. As simple as that. As simple as that. So we can just learn their line of thinking. That's about it. That's about it. Don't extend the logic. What they are saying. In this segment, for the purpose of capital structure theories, there is no preference share capital. There are only two sources of finance, which is equity and debt. Please don't ask me why, sir. Just now we read preference shares is there. These guys are assuming like that. Okay, they have done their research based on the assumption that there are only two sources of finance, which is equity and debt. Number two, tax rate is assumed to be zero unless otherwise mentioned. Clear? Only in one place we will see a tax rate, which is actually this approach with the tax. Only there we will be seeing a tax. In all other approaches, we will be seeing tax. There's not at all there. Now you tell me, in today's world, is there any country without a tax? Yes, there could be very few countries, like these are tax havens. But for that, generally a country has to run predominantly based on the revenue that is generated from a government, needs to run based on the revenue generated from the tax. So might not be relevant in today's sense. Sir, then why they are saying it? As I told you, these are the assumptions that these people have taken. Maybe when they were doing the research, taxes were not there. Maybe it could have been. So that is why they have done it like this. Then KD will always be less than KE. KD will always be less than KE. Why? The cost of debt will be less than cost of equity. Why? Because of tax saving. Correct? So they are saying in all the cases, debt is a cheaper source of finance. Are you clear with this? All the four people are agreeing to this. All the four people, that is all the four theories, are agreeing to this. Then there is no concept of retained earnings. That is, whatever the company earns, it will pay to the shareholders as dividend. There is a 100% dividend payout. That is, DPS is equal to EPS. Dividend per share is equal to earnings per share. And then the life of the company is perpetual. Are you clear with this? These are the basic assumptions. So broadly, what are the assumptions? Main assumptions: no preference source of finance. Yes, tax rate is zero. And always remember, KD is less than KE. That is, the cost of debt is cheaper than the cost of equity. Always. Are you clear with this? Yes. Now, the general formulas that we will be using in this particular segment, capital structure theories. Value of the firm, VF is the short form, is equal to value of equity plus value of debt. Are you clear with this? Why, sir? The value of the firm basically is nothing but the overall value pertaining to all the sources of finance. And in this segment, I told you there are only two sources of finance, equity and debt. So it is not just the value of equity, you should also consider the value of debt. So value of the firm, VF, is equal to VE plus VD. Does it make sense? Should you mug up anything? Absolutely not. Are you clear with this? Yes. The second part. Value of equity per share is equal to EPS divided by KE. So what is this? Time value of money concept. EPS is what? Annual cash flow. Annual cash flow divided by discount rate. For equity, what is the discount rate? KE. Annual cash flow divided by discount rate. And just now we saw there is no retained earnings. So whatever they earn, they will be giving it to the shareholders. So basically every year they will get what? The EPS itself will be the DPS, dividend per share. Correct? So annual cash flow divided by the discount rate KE, EPS divided by KE will give you the value of equity per share. Does it make sense? Yes. Should you mug up anything? Absolutely not. Logic. This is pure logic. Correct? Then value of debt, what they are saying, same logic from the perspective of debentures, from the perspective of debt holders. Let's say you have invested in debentures in this company. Now, annual cash flow that you will receive is what? The interest amount, correct? Divided by the discount rate. For debentures, what is the relevant discount rate? It is called as KD. So the value of debt, can I say, is nothing but the total interest divided by KD. Are you clear with this? Time value of money concept, annual cash flow divided by discount rate. Guys, are you clear with this? So what is the value of equity per share? EPS divided by KE. Or if you can say the total value of equity will be what? Earnings for equity divided by KE. Like that also you can say. Or EPS divided by KE, you will get the price per share. You multiply this with number of shares, you will get the value of equity. Or if you want to do it in total directly, earnings for equity, this is the amount pertaining to equity shareholders divided by what? Divided by KE. You get the entire value of equity. Are you clear with this? If you want to use this formula per share, you can use it. If you want to get the total value of equity, you can directly use this formula. Are you clear with this? Yes. Now, interesting part, the fourth one they are saying EBIT, value of the firm is equal to EBIT divided by KO. Same logic. Annual cash flow divided by the discount rate. Sir, what are you saying? EBIT, correct? EBIT minus interest gives you what? EBT, correct? In this segment, there is no taxes and all. Fine. So minus whatever is there. So let's say tax is also there. In this case, it's 0. Gives you what? EAT, correct? So minus no preference dividend here. So minus what? Minus your equity dividend. You will be left with what? You will be left with this. You will be left with what? Your retained earnings. So in this case, basically the interest and the equity dividend are paid out of what? Out of EBIT, correct? Or in other words, in this case, whatever interest I pay and the balance I have, the entire amount is retained. The entire amount is being paid to the shareholders. Nothing is getting retained. Or in other words, EBIT is fully being paid to whom? To the debt holders as well as to the equity shareholders, correct? Or in other words, EBIT is the amount available to whom? To both the sources of finance. So what is the cost of both the source of finance? KO, that is cost of equity plus cost of debt. If you weighted average based on their weights, you will get it as KO. Or in other words, in this case for EBIT, the relevant discount rate is going to be KO. Does it make sense? Are you clear with this, guys? Yes? Fine. So now annual cash flow divided by discount rate. Here you get what? EBIT divided by KO. You get the value of the firm directly. Are you clear with this? Now what is KO formula? We've already seen it, no? Cost of equity into weight of equity plus cost of debt into weight of debt. Yes or no? We have already seen this formula. Sir, no KP and all, because in this section, in this segment, we told that there is no preference shares. So there is no question of preference. Are you clear with this? So the overall cost of capital, KO, is nothing but KE, cost of equity into weight of equity plus cost of debt into weight of debt. Are you clear with this? Yes. Now let me just take a small example in calculating this. With this, we will enter into this area and see how interesting it is. Guys, you need not mug up even a single thing. You just understand this concept. It will be so beautiful. It will be so beautiful, and you will thank yourself for a lifetime for understanding this concept. Clear? Just spend little time in this marathon itself. You will get crystal clear clarity in all the 4 capital structure theories. Fine, I can guarantee for that. Now, let's get started. Now, let me just give you an example. Example 1. Let us say KE is equal to 10%, right? Then KD is equal to 5%. Then let us say equity capital is equal to 1 lakh rupees. So 1 lakh rupees is raised from equity, and from debentures, from debt, rupees 50,000 has been raised. Correct? 50,000 has been raised. Now, what will be my KO? We need to calculate KO. Now, can we calculate this? Yes, definitely. It's very easy to calculate. What is it? So, KO is equal to KE into weight of equity plus KD into weight of debt. Correct? So, in this case, what is KE? 10% into weight of equity. How much is this? So, 1 lakh plus 50,000. 1,50,000 is the total amount raised. Out of this, 1 lakh is coming from equity. Correct? So can I say this is nothing but 1 lakh divided by 1,50,000? Yes. This is the weight of equity plus for debt. What will it be? KD is 5% into what is the weight of debt? Weight of debt is going to be 50,000 divided by 1,50,000. Correct, guys? Yes. Fine. So in other words, so you can just do the calculation. You get how much? You get 8.33% as your overall cost of capital. Are you clear with this? You get 8.33% as your overall cost of capital. Now, why did I show this? Why did I do this and show it to you? Not to tell you how to do this calculation, all that you know it better than me. Now, the reason why I told this is to make a small observation. Now, you tell me, In this question, what was my KE, cost of equity? 10%. What was my KD? 5%. Correct? Correct? So cost of equity is 10%. Cost of debt is 5%. Correct, guys? Yes. Now, what is my overall cost of capital? KO. Now, KO, you tell me, will it be greater than 10%? Will it be less than 10%? Or what will it be? Generally, what students think is KO means what? Overall cost. So overall cost should be more only. So it will be more than 10%. No, guys. No, it is not like that. Simple mathematics. Simple mathematics. Look, 1 lakh rupees, I am raising it by 1 lakh. To the extent of 1 lakh rupees, the cost is 10%. To the extent of 50,000 rupees, the cost is 5%. Now, for this entire 1,50,000, you tell me what will be the cost I am averaging out. It will definitely be less than 10%. Are you clear with this? Why, sir? Because 1 lakh, for 1 lakh, I am paying 10%. For the remaining 50,000, I am paying only 5%. So overall, 1,50,000, it averages out. It becomes less than 10%, but more than 5%. It lies somewhere in between. Are you clear with this? And that is where we are saying the cost of capital in this case is how much? 8.33. Or in other words, you can say that KE, KD, and KO. Now, in this case, what is my KD? 5%. What is my KO? 10%, right? And always remember, KO lies somewhere between this KD and KE. It cannot go beyond KE. It cannot go below KD. Why? Because what do you mean by overall KO? Overall cost of capital. That is the cost pertaining to 1,50,000. Correct? To the extent of 1 lakh only, I am paying 10%. Correct? Yes. So now for the remaining 50,000, I am paying only 5%. Correct? So for the entire 1,50,000, it averages out. Correct? Now it cannot be greater than 10%. Why? Because for 1 lakh only, I am paying 10%. After that, I am paying in fact lesser than that. So it cannot exceed 10%. Correct? Can it go below 5%? No. For 50,000 only I am paying 5%. In fact, for the remaining 1 lakh, I am paying 10%. So it has to be more than 5% only. Are you clear with this? Or in other words, always remember this. Always remember this. KO lies somewhere between KE and KD. Are you clear with this? Remember this rule. Remember this as a thumb rule. Some students mug it up. Please don't mug it up. It's a trap. You don't mug it up. You just learn it by concept. Are you clear with this? Why? Simple mathematics. Law of averages. You take a weighted average, you see it for yourself. Obviously, it will be there. One source of finance is from a costly source. Another source of finance is a cheaper source. Overall finance is going to be average of the two. And average of the two can only lie in between the two. It cannot exceed or it cannot go below the other. Are you clear with the simple mathematics, guys? And this is logic, common sense. Clear? So now look at this. Look at this. So can I come to a conclusion? Can I come to a conclusion saying that KE, KD, KO. So can I say that KO is always greater than or equal to KD, but it is always less than or equal to KE? Yes or no? So can I say KO lies between KE and KD. It can never be more than KE. It can never be less than KD. Are you clear with this? Yes. Yes. And we already saw that KE is always greater than KD. Why? Because of its tax saving effect and all of that. We've seen it. And of course, in fact, KE means what? Cost pertaining to equity shareholders. You tell me, equity shareholders are risk takers. Correct? So more the risk, they will expect more return. Correct? So obviously, KE will always be equal to KD. The question here is, where do we plug KO? So remember, KO lies somewhere in between this. It cannot go beyond KD. Sorry, it cannot go beyond KE. It cannot go below KD also. So your KO cannot go beyond your KE. It cannot go below your KD. It can lie somewhere in between this range. Are you clear with this? Yes. Now, let me give one more example. And with this, let us learn one more conclusion. Look, I'm actually giving you a right introduction into this area. Once you learn all these things, you will never forget it for a lifetime. You cannot miss this area at all. Are you clear? So this is in fact a core area. Whatever chapters that we've been doing, every attempt, more or less every attempt, your leverages, cost of capital and capital structure theories, these three chapters in an investment decision, more or less every attempt, it comes for 10 marks each chapter. So that makes it 40. Are you clear with this? So FM is not even a full 100-mark paper. Correct? It's only half. Correct? So 50 marks for new syllabus from May 2024 onwards. For the existing syllabus, November 2023, it is only for 60 marks. Out of this itself, 40 marks come from these 4 chapters. Predominantly, it's done. So this is a never miss. This is a never miss. So please have this in your mind. Now, let me just give you an example too. Let me just give you the example too. So what is this example to? Everything is the same. That is, KE is 10%, KD is 5%. So what is happening? KE is equal to 10%, no change. KD is equal to 5%, no change. But there is only one change here. Equity debt, I am changing this. So equity, I am saying, is 30,000 rupees. Now debt is going to be how much? 1,20,000 rupees. Equity is 30,000 rupees and debt is going to be 1,20,000 rupees. Clear or not? Now you tell me, what is the total amount raised? 1,50,000. Now, has this amount changed? No. In the previous example also, the overall amount raised was 1,50,000. KE standalone was 10%. KD was 5%. Are you clear with this? Now, what has changed here? The mix, capital structure has changed. The proportion of debt and equity has changed. Or in other words, the weight of equity and the weight of debt alone has changed. Now, you tell me, what is the formula to calculate the overall cost of capital? KE into weight of equity plus KD into weight of debt. Correct? Guys, logically think, please don't mug it up. Logically, you think about this. Now what is KE? KE is going to be 10% into weight of debt. It's going to be 30,000 divided by 150,000. Correct? So 30,000 divided by 150,000. I'm just writing this in short form. Okay. So let me just, 1 second. I'll erase this K, so don't get confused here. So this is just 30 by 150. This is nothing but 30,000 by 150,000 plus debt is going to be 5% into what? Into 120,000 divided by 150,000. Correct, guys? Yes, are you clear with this? Yes. So now if you do this, you do the calculation, you will get KO is equal to 6%. KO is equal to 6%. Now, what can you conclude with this? Guys, this is a very, very important observation, which is the base for us to enter into the capital structure theories. So I'm just giving you a launching pad for entering into this area. Fine. In fact, this segment alone, I'm doing it as if you have not learned it at all. In your lifetime, first time you are learning this. From this marathon also, you can learn it. Clear with this. So now, look at this. What you can see. What was initially my KO? So initially in the first case, KO was how much? 8.33%. Correct? 8.33%. Now what happened? Look at this. In the first question, KE was how much? 10%. KD was how much? 5%. Now, how much amount was raised from equity? How much amount was raised from debt? So from equity, we had raised how much? 1 lakh rupees. From debt, we had raised 50,000 rupees. Correct? So 1 lakh rupees from equity, and from debt, we had raised 50,000 rupees. And the overall cost of capital came to how much? Sorry, this is KO, right? KO came to how much? The KO came to 8.33%. Yes, it came to 8.33%, right? Now, carefully listen. In the second example, what we did, KE did not change. KD did not change. Now, equity and debt alone I changed. I made this as 30 and 120, correct? So what happened here? Here 30,000 was raised from equity, but 1,20,000 was raised from debt. Now, when this happened, my KO became how much? 6%. Now, what is the conclusion that you can draw? Now, why has my KO dropped from 8.33% to just 6%? Why it has dropped? Now, logically you think and tell me. Now, in the first alternative, so now we know that equity is a costlier source of finance, debt is a cheap source of finance, correct or not? Yes. Now, in the first alternative, I have raised more money, 1 lakh rupees from a costly source of finance, and only 50,000 rupees I have raised from a cheaper source of finance. Now, what happened here? I changed the mix. Overall, I got the same 1,50,000, but what I did this time, I raised more money from a cheaper source of finance and lesser money from a costlier source of finance. Because of this, in the average, when I did an average, overall cost of capital dropped from 8.33 to 6%. Why it dropped? Because the second alternative, I have raised more money from a cheaper source of finance. Or in other words, in this case, what happened? In this case, what happened? Can we say that the weight of debt has increased? That is, if you infuse more debt, debt is what? Cheaper source of finance. If you infuse more debt, it will result in a reduction in your KO. Yes or no? Yes or no? So can we say that, can we come to a conclusion that more the weight of debt, WD means what? Proportion of debt in the capital structure. More the proportion of debt in your capital structure will result in lesser cost of capital. Lesser cost of capital, that is nothing but KO. Can we come to this conclusion or not? Earlier it was what? The average cost of capital. So now it was what? 8.33%. It was somewhere here. Now it has become 6% only. Why? Because now out of the total capital, I'm infusing more debt and lesser of equity. So more the debt percentage in the capital, obviously lesser will be your overall cost of capital, because overall cost of capital is nothing but a simple average. It is nothing but an average of your weights with your respective cost. Are you clear with this? Yes, are you all clear with this? And remember, at no point of time KO can be more than KE. It cannot be less than KD also. It has to be somewhere in between. But this we can range it. How we can range it? If you infuse more debt, your KO will fall down. Are you clear with this? Yes. So this is the overall conclusion that we can come up with. So more the proportion of debt in your capital structure, lesser will be the cost of capital. Are you clear with this? Are you clear with this? If you are clear with this, then we will move to the next illustration, where I will just connect all these things, and then we will enter into the 4 capital structure theories. We can do it very, very easily. Clear? So the next one that I want to do now, this is example number 3 that I'm going to do. Now, let us say EBIT is, let us say 1 lakh rupees is 1 lakh rupees, and let us say KO is equal to 10%. Let's say KO is equal to 10%. Now, we need to calculate what? The value of the firm. The value of the firm, right? We need to calculate the value of the firm. So can you calculate the value of firm? Yes. So what is the value of the firm? Can we say value of firm is nothing but EBIT divided by KO. We just saw this formula, correct? EBIT is the earnings available to whom? Debt as well as the equity shareholders, correct? So the discount rate should be what? The average cost of capital, that is nothing but your KO. Yes or no? Annual cash flow divided by discount rate. Just now we saw the logic. Yes, guys, are you clear with this? This formula, value of firm, correct? So can I say this is nothing but 1 lakh divided by 10%. So what is the value of the firm? The value of the firm will be rupees 10 lakhs. Yes. Yes, guys, are you clear with this? Now, let me take one more example. Example number 4. Let's say the EBIT remains the same, 100,000, right? But now the KO changes to, let us say, 5%. The KO drops. Now calculate what the value of the firm. So now value of the firm is nothing but EBIT divided by KO, correct? Or this is nothing but 1 lakh divided by 5%. That gives you value of the firm as how much? 5 lakh rupees. Are you clear with this? So what is the conclusion that you can draw here? If your cost of capital is less, automatically the value of firm will be more. Can you accept this or not? Mathematically, if your denominator reduces, obviously the value increases. Yes, guys. Yes. Let us say you have a piece of cake. You have a piece of cake, and now let us say you're the only person who is having it. Yes. Now you will get the entire cake for yourself. Suppose there is one more person with whom you need to share. It becomes, your share becomes half or 0.5 only, correct? Or in other words, more the denominator, lesser will be the answer. Or lesser the denominator, more will be the value, the answer. Are you clear with this? So if your KO reduces, your overall value of the firm increases. Are you clear with this simple mathematics? Simple mathematics. So can we arrive at this conclusion? If I infuse more debt into my capital structure, that is the weight of debt, that is, if I infuse more debt into my capital structure, what will happen? So more the debt in your capital structure, it will result in a lesser KO, correct? KO means what? Average cost of capital, weighted average cost of capital. Are you clear with this? And when your KO reduces, what happens? Your value of the firm increases. Are you clear with this? And what we saw here is what are the good characteristic features of an optimum capital structure. In an optimum capital structure, the value of the firm should be maximum and the cost of capital can be minimum. Or in other words, your value of firm can be maximum only when your KO, the cost of capital, is minimum. Are you clear with this? These two are interlinked. And how can I make my cost of capital, overall cost of capital minimum? By infusing more debt. Why, sir? Because debt is a cheaper source of finance. Are you clear with this conclusion? And if you are clear with this conclusion, now it is the right time to enter into the capital structure theories and see what each of these scholars, what each of these people have said. What are their assumptions? For their assumptions, what they have said is what we are going to study here. Guys, are you clear with this? A very, very important way to get introduced into the capital structure theories. Now, there are four theories: net income approach, net operating income approach, traditional approach, and approach. Approach we have without tax and with tax. Okay, let us see one by one. First, I will teach you all the concepts, and then we will be doing a few problems, and we are done with it. Clear? So now net income approach. Now, what is this net income approach? So this approach was given in the year 1952 by David Durant. If you want, you can remember the name. Fine. Then, according to this approach, capital structure decision is relevant to the value of firm. Sir, what is the meaning of this? They are saying, so capital structure, because of your capital structure is basically what? Debt to equity mix, the proportion of debt equity, that is all equity or all debt or 50-50, 30-70, 20-80 or 80-20, anything. This mix, the proportion, the source of finance will actually impact your value. That is what? Value of the firm. That is what this approach says. So that anyways we know, no sir, wait, because there are certain methods which says that your capital structure decisions will never impact the value of firm. So how is that possible? That is their assumption. We will go to that later. So that's why it is very clearly mentioned that the capital structure decision is relevant to the value of the firm. In other words, your source of finance will impact the value. Who says this? The first method called as NI, net income approach. This theory suggests that the value of the firm can be increased by decreasing the KO, and KO can be decreased through a higher proportion of debt in the capital structure. We just saw it right now, correct? So you want to increase your value of firm? Yes. What you need to do? Reduce your overall cost of capital. So how do I reduce my overall cost of capital? Infuse more debt. Are you clear with this? That is what they are saying. So under NI approach, KE is always greater than KD. This we know. And KE and KD remain constant. Meaning what? Whether you raise, in this example we saw, whether I raised 50,000 rupees from debt or I raised 1,20,000 rupees per debt, the KD did not change, correct? So whether you want to raise 1 rupee or 1 crore rupee, in this assumption says, in this particular theory, they are saying that KD will not at all change. KD will remain the same percentage. So because you are taking more amount, I will not charge more interest percentage. As a percentage, interest will, your KD will remain the same. Are you clear? Similarly, KE will also not change. Here we are raising only 1 lakh rupees from equity. Here we are raising 30,000 only. Here we are raising 1 lakh rupees. Here we are raising 30,000 rupees only from equity. So now, because of the amount that you are raising from the source of finance, these individual costs will not change. That is the assumption they are saying. Are you clear with this? Why is that? That is the assumption that they are making. Clear? So because of your amount that you are raising from the different particular source of finance, its cost will not change. Are you clear? Its respective cost as a percentage will not change. Are you clear with this? Yes. Now, what they are saying is, therefore, higher the weight of debt, more debt, lower will be the KO, and more the KO, what will happen? Sorry, more the debt, more the weight of debt, what will happen? Higher the weight of debt. This will result in lower KO, and lower KO results in higher value of firm. Are you clear with this? This is the one-line summary of this particular theory, and they have given the graph like this. What is the graph that they are given? Wait, I will draw and show you. You will have crystal clear clarity here. Very, very, very simple, guys. So whatever we have seen, they have given a name called as what? net income approach. So whatever we have learned logically, that logic is given by a name called as net income approach. Are you clear with this? And this was founded by a guy called David Durant. Now look at this. So this is what the first one, that is net income approach. Net income approach. Now always remember, in a graph you will be having x-axis and y-axis. Yes, obviously you guys know that. Yes, so now on the y-axis you have cost as a percentage, right? And on the x-axis you have the weight of debt. You have the weight of debt, that is the proportion of debt in the capital structure. Are you clear with this? Yes. Now what they are saying is, first, in this method, what they are saying, always KE will be constant, correct? KE will be constant. This is what they are saying. So KE will be constant, correct? KD will also be constant, correct? So because I am infusing more debt, let us say this is 0% debt, that is no debt, all equity. Let's say this is 50% of the overall amount is being raised through the debt channel. Let's say 100% is coming from debt. Just an example. Okay. Now, what they are saying is, because I am starting to borrow more money from the debt channel, it will not impact my KE, it will not impact my KD. The respective cost will remain the same. Correct? That is what this is saying. But what happens to KO? Come on, tell me what happens to KO. They are saying, as you infuse more debt into your capital structure, your KO will start falling. Are you clear with this? And KO, if there is zero debt, means what? The entire source of finance is only equity, correct? If you are entirely raising the money through equity, then at this point, KO is equal to KE, correct or not? Why? Because entirely it is funded through KE. KE is the only source of finance. Are you clear with this? Yes. Or if everything is raised through debt, then overall cost of capital is equal to KD, correct? Yes, why? Because the debt is the only source of finance. Are you clear with this? Yes. So now, as I keep increasing my proportion of debt in my capital structure, my weighted average cost of capital keeps falling, and that is what this method says. And this is the graph that they have given. Are you clear with this, guys? This is very simple to understand, and please don't mug it up. Please don't mug it up. You should know what is there in the x-axis and y-axis. These two things you should know, and then you should also look at the assumptions, and with this you are done. So the day before your exam, you give one look at this particular graph, you will get an entire understanding of whatever discussion that we have made in net income approach. That should be the power of conceptual learning. Are you clear with this? You do this and you're done with this. That's all. Any kind of sum, let them do. We can actually handle it. That should be the level of confidence you should have. Clear with this? So basically this method says what? Now your KE and KD remains constant, and KE is always greater than KD. That's why KE is above, KD is less. As you increase more component of debt into your capital structure, that is, as you infuse more debt as a percentage, if you infuse more debt into your capital, your overall cost of capital will reduce. Why and all we saw, because now you are raising more money from a cheaper source of finance. And always remember, KO lies between KE and KD. Correct? It cannot go beyond KD. It cannot go beyond KE. It cannot go below KD. So it can be. That is the reason why I said it. That is the reason you recall this. I said this particular conclusion I made. Look at this. This particular conclusion that I made. Fine. So this conclusion. So KO. So look at this. KO can be between KE and KD. That is, KO always is more than or equal to KD, but it is less than or equal to KE. Are you clear with this? So when will KO be equal to KD? When entirely I am raising all the funds through the debt channel. Correct? When KO will be equal to KE, when entirely you are raising it from the equity channel. Are you clear with this? And if there is a mix of equity and debt, it will lie somewhere in between. And that is what we are seeing here. Are you clear with this in this particular graph? Guys, as simple as that. What is the point to mug it up? Please don't mug up. In exam, even if they are asking you for a graph, a rough graph they are asking, you can do it. In no time you can do it. That should be your level of understanding in this particular area. Clear with this, guys? Yes. So leverage. They have mentioned leverage here, sir. Leverage means what? I told you. Leverage means what? So leverage happens. The magnifying effect, it happens because of what? The presence of fixed financial cost. When will you have the fixed financial cost? Because of debt only. Yes or no? Yes. So basically, leverage means in this case, it is nothing but the proportion of debt in the capital structure. That is the indirect meaning. So you don't think exactly like a bookish definition. You don't say that, sir, leverage chapter, they are putting it here, not leverage. Think about it. They are talking about the proportion of debt here. Clear with this? Yes. So this is why they have mentioned it like this. Sir, now don't ask me exactly it will go like this or will it be a curve. You can do it like a curve also. It is not a problem. Exactly, it will not go. It is not a linear relationship. It can go in any which ways. Are you clear with this? So there is nothing of exactly it should be like this. It depends on the respective weights and the respective costs. So it can differ from the facts given in the question. Are you clear with this? So now let's go to the next approach, which is called as the NOI approach, net operating income approach, NOI. Now, what in this approach, what are they saying? Now, they are saying completely the opposite of net income approach. So net income approach was more logical. So we saw that as you increase the proportion of debt in your capital structure, so what happens to your KO reduces and automatically your value of firm increases. This is basically logical. Now, what net operating income approach is saying, this approach is exactly the opposite of NI approach. As per this approach, the capital structure decisions are irrelevant. Now, irrelevant. How are irrelevant? They are saying your debt equity, right? Your total capital, right? Your debt and equity, the capital structure, the proportion of debt and equity and all will never impact the value of the firm. This is what they are saying. But there we saw, if you increase more of debt, what will happen? If you infuse more debt, your KO will reduce and the value of firm will increase. Here they are saying no, it will not impact the value of firm. And they are saying as per this approach, the value of the firm and KO will always remain constant. They are saying because of your capital structure, you cannot increase the value of firm or you cannot reduce the KO. It will always be the same. Are you clear with this? The value of firm cannot be increased or decreased by changing the proportion of debt in the capital structure. Sir, how is this possible, sir? See, this is a particular approach. That is, a person has found this particular approach for his assumptions. For the assumptions made by that person, he is stating this is how it is. I will explain whatever it is saying. Are you clear with this? So in exam, how do you approach it? They will give you some data and they will ask you to calculate the value of the firm, or they will ask you to calculate something based on NOI approach. So they will give you. So once you give the approach, once they give you the approach, you will know what are the assumptions in it. So in short, what does this approach say? This approach is saying KE is always greater than KD, that we have seen. Cost of equity is more than debt. Why? Because equity shareholders are risk takers. More the risk, more the return they will expect. Correct. So KE is more than KD. Now look at this. KD will remain constant. Meaning what? Meaning what? See, just because I am raising more funds from my debt channel, it will not change my KD. So KD will be the same constant percentage. Whatever is the KD, whether I raise 1 rupee or 50 lakh rupees or 50 million rupees, KD will remain the same. That is the underlying assumption they are saying. Now they are saying, look at this here, KO will also remain the same. They are saying KO will also not change. They are saying if I increase the proportion of debt in my capital structure, he's saying it will not impact the KO. But look at this, KE will increase with increase in debt. What he's saying, KE alone will increase as you increase the proportion of debt in your capital structure. Or in other words, if you infuse more debt in your capital structure, KE will increase. Sir, why KE will increase? Now, what the logic that this approach, NY approach says is, now, if you increase more debt, if you infuse more debt in the capital structure, what happens? You need to pay more interest, correct? Interest is what? A fixed financial cost. So more the fixed financial cost, what will happen? It is actually more risky for the company. Yes or no? Yes, leverage effect is there, no doubt. But I told you it's a double-edged sword. Correct? It can also go against your favor. So it is more risk, more the risk. Now the shareholders will start expecting more returns and hence KE will also increase. That is what is the assumption that NY is saying. So NY is saying more the proportion of debt, KD will not change, KO will not change, but KE alone will change. Why? Because more the debt, more the risk, more the risk, more the return. That is the expectation of the equity shareholders. So KE will also increase. This is the underlying logic that NOI approach says. Are you clear with this? Sir, okay, sir, we understood. as your debt increases, as your proportion of debt increases, said KD remains constant, fine. KE changes, that is also fine. But sir, how can you say that KO will remain as a flat line? How does KO not change? When KE is changing, obviously the mix proportion is changing, no? So KO should also change. Now let me give you an example. Let me give you an example. And this is the example under NOI approach. Let me just give you an example under NOI approach. Now, what is this example? So, example number 1, let us say KE is equal to 10 percentage, KD is equal to 5 percentage, then weight of equity is equal to 0.666666, then weight of debt is equal to, let's say, 0.333333, right? Now, let's calculate the cost of capital. So, what is going to be the cost of capital here? KO is going to be, so what is this going to be? So, it's going to be 10 percentage into 0.666666, correct? 10 percentage into 0.666666 plus KD 5 percentage into 0.333333. So, you can do the calculation. It will come to how much? 8.33 percentage. Are you clear with this? Yes. Now, what NOI approach says is, example number 2, KE becomes 21.65 percentage. KD will not change under NOI approach, 5%. Weight of equity is how much? Right now it is reduced 0.20 and weight of debt is 0.80. So now what happens? Earlier the debt was only comprising of 33% of my entire capital. Now I am infusing more funds to the debt channel. So now the weight of debt increases to 0.8. Now what does NOI approach say? Now KD will remain constant because of this. Because of infusing more debt, will my KD change? No, it will not change. Correct? But will my KE change? Yes, they are saying KE will increase. Correct? He's saying KE will increase from 10 percentage to how much? 21.65 percentage. Why, sir, KE is increasing? Because now you are infusing more debt. Correct? More the debt, more the risk. More the risk, more will be the return that the equity shareholders will expect. So now you compute this, you compute the KO here. So KO will be 21.65 percentage into 0.2 plus 5 percentage into 0.8. If you compute, you will get exactly 8.33 percentage. Or in other words, NOI approach says that now because of increase in the proportion of debt, so what happens? Your capital, your overall cost of capital remains to be 8.33%. That is, if you infuse more debt, in your capital structure, if you infuse more debt, that is weight of debt. If you infuse more debt, 0%, 50%, 100%, right? And here it's going to be what? Cost as a percentage, right? So what they are saying is, so just because you are increasing, if you are infusing more debt in your capital structure, KD will not change, it will remain constant. He's saying KO will also not change, but what will happen? KE alone will increase. Now you tell me, when KO is not changing, obviously the value of firm will remain the same only. Yes, the value of firm will also not change. That is why they are saying the debt equity mix, or in other words, the capital structure decisions are irrelevant for with respect to the value of the firm. That is, the value of the firm will remain the same irrespective of your source of finance. That is what they are saying. Now you might have a doubt. Now, sir, then let me just take another figure here. KE, you did 10%. Now you increase the KE to 21.65%. Now, sir, why will KE exactly increase from 10% to 21.65%? Correct? Suppose I'm taking this as 20%. If you take this as 20%, then KO will not be 8.33, it will be something else. Sir, then what is this, sir? So is this cheating or not? No. What this guy says, what this method says is, look, what happens when you increase the proportion of debt? What happens when you increase the proportion of debt? There is a low cost advantage from debt. Correct? He's saying the low cost advantage of debt is exactly offset by increase in your KE. That is, the benefit that you get by low cost advantage of debt is getting offset exactly to the extent of that benefit. It gets offset by increase in equity. That is, one benefit is being offset by another negative. So automatically overall there is no change. So it makes your overall cost of capital equal. But what is the assumption he is doing here is, if you increase your proportion of your debt in your capital structure to the exact advantage, you get some advantage. Why? Debt is a low cost of low cost capital, correct? Exactly to the extent of advantage that you get, the low cost advantage of debt will be offset by increase in equity. Your equity KE will increase exactly to that level to make sure that overall that KO does not change. Are you clear with this? Sir, will exactly KE move from 10% to 21.65%? In real life, it will not happen like that. Then why are we studying this? Because this net operating income approach is stating that this is how it will happen. Are you clear with this? So please don't worry about the logic here. They are saying the net operating income approach says that this is how it will happen. Clear? And this is a part of our syllabus, so we are doing it. As simple as that. Sir, will KE exactly increase from 10% to 21.65%? In real life, it will not happen. But NOI approach says that it will happen like this only, so that overall, to ensure that overall your cost of capital remains the constant. Are you clear with this? And when KO does not change, so value of firm is nothing but what? Value of firm is nothing but EBIT divided by KO. Correct? And when KO does not change, EBIT also does not change with your capital structure. I told you, yes, EBIT will not change. It's an operating profit. It has nothing to do with your financial structure, correct? Or capital structure, correct? EBIT will not change. Now, under NOI approach, KO also will not change. Then obviously the value of firm will never change because of your change in capital structure. Are you clear with this? And this is what the net operating income approach states. Clear with this, guys? Are you all getting an understanding about this? So look at this. As per this approach, the increase in the use of debt, which is apparently cheaper, is offset by an increase in KE. So increase in WD, weight of debt, you get some advantage, correct? To the extent of disadvantage, this particular advantage, what happens? The KE also parallelly increases. If KE increases, it's a disadvantage. So what they are saying, this advantage is being offset by this advantage, and particular this disadvantage. And overall what happens? It nullifies the effect on your KO. This is what it is saying. But clearly from 10% will my KE increase exactly to 21.65%. In real life, it will not happen like that. But that is what this approach says. It says it should happen like that. But in real life, will it happen? No, that's $1 million question, which will not be the case. Are you clear with this? Are you clear with this? We are just talking about this approach, the theory, that is this particular perspective of looking at things. This happens because the equity investors seek higher compensation as they are opposed to greater risk due to the existence of fixed return securities in the capital structure. Fixed return security is nothing but debt. So more the debt, now what happens? More the risk. More the risk, they expect more return. That I accept. The logic for increase in equity KE I accept, but will the KE exactly increase from 10% to 21.65%? That is a very debatable thing. That's why we read it under capital structure theories. We are just saying what a particular person's perspective is on the capital structure. Are you clear with this? So just look at it from a third party perspective. Someone else is giving you one perspective. We are just looking at it as simple as that. Are you clear with this? Now let's go to the next one. So this is what they are saying. KD remains constant. KW, that is KO, also remains constant. With increase in your degree of leverage, that is, it increase in your proportion of debt in your capital structure, KE will increase. But what they are saying is, how sir KO remains constant? The advantage that comes by way of low cost debt is being offset by the disadvantage in your increase in EKE. Are you clear with this? That's what he's saying, and it gets exactly offset to balance your KO at any given capital structure mix. This is what they are saying. Is it practical? No, it is not practical. It's just a theory that we are studying, and this NOI approach states that. Are you clear with this? Next, traditional approach. Now, what does this traditional approach say? Now, before we move into it, let me just summarize the discussion here, because these two are the base. Net income and net operating income are the base. So let me just summarize this. KD, KE, KO, KF. Sorry, not KF, it's VF, value of firm. Right? One second. See, this is actually a super summary. A super summarized version of whatever we have studied till now in this particular capital structure theories. So now, what does NI approach say? What does NOI approach says? NI approach says net income. First approach says KD will remain constant. That is, if I increase with the increase in the proportion of debt in the capital structure, KD standalone will not change. KE also standalone will not change. Correct? Yes. KO will change. That is, it will decrease. As you increase your proportion of debt, KO, what will happen? Will decrease. And because KO decreases, your value of firm will increase. This is what we saw logically. Yes. Now, what are they saying in NOI approach? NOI approach, they are saying, as you introduce more debt in the capital structure, will KD affect? No. So the KD will remain constant. Correct? Now what happens to KE? More the proportion of debt. He is saying more the debt, more the risk, more the risk, more the equity shareholders return expectation. So this will increase. Correct? But what he's saying is the weight of debt, the advantage that you receive by low cost debt is offset by a disadvantage by increase in equity. So overall, he says it will not impact my KO. So KO will remain what? Constant. And because KO remains constant, the value of firm also remains constant. Sir, which is correct? That's why I said please don't compare for the assumption. Ideally speaking, this is correct, or I wouldn't say correct. This is relevant in today's life. But NOI approach has its own hypothesis. It says whenever there is a change in your debt, weight of debt, that is the proportion of debt in your capital structure, your equity, KE will increase in exactly such a manner that to ensure that overall it balances and KO does not change. That is the hypothesis, that is the assumption for NOI approach. Are you clear with this? Let us not question back this theory. These theories are well established. They are given by people. We are just studying what these people have said. That's all. Don't say which is right or wrong. That is not what we are going to do here. Are you clear with this? Now, let's go to the third one, which is called as the traditional approach. Now, what does traditional approach say? According to this approach, capital structure decision is relevant to the value of the firm. So, meaning what? So, capital structure decision, the proportion of debt and equity in your capital structure will impact the value of the firm. That is what they are saying. Yes. So, by a proper mix of debt and equity, KO can be reduced and VF can be increased. Yes, this is what they are saying. Sir, then what is this method saying? So, this is similar to the first approach, that is net income approach. No. They are saying, but only part of difference is they are saying this approach has 3 stages. They are saying in the first stage, KE and KD will remain constant. KO will decrease with increase in the debt and KE is always greater than KD. So what is this? Very simple. They are saying first initially net income approach will be happening. They are saying initially in the initial stages, KE and KD will remain constant. Correct? KE and KD will remain constant. So let me just put it here. This is what the traditional approach. So now look at this. This is how the graph looks like. The percentage of debt in your capital structure. Let's say it's 0%, 50%, 100%. As I keep increasing the proportion of debt, and this is going to be a cost in terms of percentage, right? In terms of percentage. Now, what this traditional approach says is initially, what will happen initially? So initially, your KE and KD will not change. So as you infuse more debt into your capital structure, they are saying your KE and KD and all will not change. So he's saying, so KD will remain here, KE will remain here. Okay, so let me just use a different color. Okay, so I'm just using green ink here. So KE, so this is KD. He's saying this is KE. Okay, always KE is greater than KD. We know that because KE is a costlier source of finance, KD is a cheaper source of finance. But what he's saying is, so KE and KD will remain constant. They will not change just because you are infusing more debt in your capital structure. But what happens? Your KO will start falling. Yes, that is nothing but your net income approach. Yes, why it starts falling? Because as you increase the proportion of debt in your capital structure, so now you are raising more money through a cheaper source of finance. So now what happens? Your overall cost of capital falls. Correct? Now this will happen to some extent. Then what he's saying, stage 2 will start. What is stage 2? KE will increase with an increase in the debt. Now beyond the point, what he's saying, if you further infuse more debt, now KE will start increasing, KD will remain constant, now KO will also remain constant, and KD is always greater than KD. What is this? Nothing but NOI approach. He's saying beyond a point, now NOI approach will start. beyond a point, NOI approach will start. So initially NI approach will be there. Then beyond a point, if you still further infuse debt, beyond certain point, NOI will start functioning. So how will NOI look like? How will NOI look like? So this is the first stage. Yes, this is how the first stage looks like. Correct? Now, in the second step, what happened? In the second phase, what happens? Now, KD remains to continue constant. Correct? But now what they are saying, KO also remains constant. Yes, because NOI approach. Correct? Now what they are saying, slowly KE will start increasing. Are you clear with this? Are you clear with this? This is what they are saying will happen in the second phase. This is nothing but what? This is nothing but what? This is nothing but your net operating income approach. So this is basically your NI. This is basically your NOI. Are you clear with this? And if you further infuse debt, what will happen? This is what they are saying. Beyond a point, if you still keep infusing debt in your capital structure, now KE will increase. Correct? Now KD will also increase. Yes, KO will also increase, and K is always greater than KD. Now what they are saying, beyond a point, if you still keep on infusing more debt, he's saying KD will also now start increasing, KO will also now start increasing, KE will also now start increasing. Sir, why sir? Now, if you further infuse beyond a point, if you still keep on infusing debt, correct? If you keep on infusing debt, so this is KE, this is KO, this is KD. What happens? What happens? Now, more the debt, what happens? So you're borrowing, you just keep on borrowing, more the risk, correct? So equity shareholders are risk takers. Now they will start demanding more return, correct? So the KE will increase. So then why KD is increasing, sir? Just imagine, there are two people, okay? One guy is actually going to a bank, okay? And he's going to the bank for the first time to get a loan. Yes. Now there is another guy who already has a lot of crores of rupees as loan. He has taken somewhere else. Now he wants to take one more loan. Now you tell me, in which of these two scenarios, among these two people, from the bank's perspective, who is more riskier? Obviously, the person who has already raised funds from, he's already raised loan, and now he wants to add some more loan. This guy seems more riskier. So now this guy is more riskier. The second guy is more riskier. So obviously the bank will charge more interest for him, because yes, this guy is more riskier. So for him, I will charge differently, correct? Even that happens in a debenture model. That happens in debt also. So beyond a point, even these debenture holders will be careful. They will say, look, you already have raised so much money from debt. If you are making a further issue of debt, now we want more interest, because now we are also starting to take some amount of risk. Are you clear with this? So these guys will also take. Now KD also increases, KE also increases. Obviously, KO will increase. Are you clear with this, guys? Is everyone able to understand? So the third phase, where traditional method says is, now all the three will start increasing. So traditional method is not a standalone method by itself. It says up to some extent. What is that some extent? It depends. It says overall the graph will happen in three phases. Phase 1, net income approach. Phase 2, net operating income approach. Phase 3, all the three will increase. Are you clear with this? So the KO will actually fall here, then it will remain constant here, and it will increase here, correct? And your value of firm is dependent upon KO, correct? Yes. So in this case, what will happen initially? In the initial phase, the value of the firm will keep on increasing as we pump in more debt. And for certain point of time, even if you increase debt, it will remain static. The value of the firm will remain static. Yes or no? Yes or no? Now beyond a point, since KO start increasing, now value of the firm will be decreasing now, and beyond the third phase, since KO increases, the value of firm will decrease. Are you clear with this? So basically this method, traditional approach, says that now the entire capital structure decisions are relevant. Why? Because KO is changing. Whenever KO changes, your value of firm will change, correct? And now they are saying the capital structure decisions are relevant, but how they are relevant? They are relevant in a different perspective. Are you clear with this? Initially, net income approach will happen, then net operating income approach will happen, and finally everything will increase and shoot up. So now when your KO also increases, your value of firm will come down. This is what the third method says. Are you clear with this? So as per the traditional approach, the optimum capital structure will lie between stage 1 and stage 3. So between this only, the optimum capital structure will lie. Are you clear with this? That is what they are saying. And look at this. This is the graph given in the study material. So you might not exactly know this, you may not exactly remember. So that's, I mean, you might not exactly connect with this. That's why I drew it here. So one phase is NI approach. That is, to some extent, NI will happen. NI will happen. Look at this. This is remaining constant. This is also remaining constant. And this is falling slowly. Correct? It will not go till this. Why? Because if you want your KO to be equal to KD, then this should be 100%. They are saying no, it will not even reach 100%. Are you clear with this? So it goes only to some extent. Are you clear with this? Then beyond this point, what happens? Beyond this point, what happens? KO remains constant. Correct? KD also remains constant. But now KE alone increases, and beyond the point, what happens? Everything starts to increase. KE, KD as well as KO, everything increases, and this is a three-stage approach, a three-step approach, and that is what is called as traditional model. Sir, will it exactly happen like this? This is the theory that they are giving, as simple as that. So we are just studying whatever research that these people have made. They are saying it will always happen like this. Fine, it might not happen like that. We are just studying their analysis. Are you clear with this? Yes. Now I think this. Okay, so this particular method, this particular traditional approach, fine, was introduced by a person called Ezra Solomon. Okay, Ezra Solomon. Now, I remember this in my regular class. I mentioned this. So once I finished this traditional approach, one student asked me a doubt. Now, okay, I was very interested to take the doubt. I asked him, yes, tell me the doubt. Now, I thought he's going to ask me something about the traditional approach. He asked me about the traditional approach only. But for a change, his doubt was interesting. He wanted to know whether Ezra Solomon is a male or female. Now, very interesting doubt. I thought this guy will ask me a real good doubt. But look what this guy is interested in. But anyways, then I did a research. I mean, I just Googled it up and I found that this is a guy only. It's a male. Okay. But that apart, see, there are so many really interesting things to learn here. But look what our guy had a doubt in this particular area. So he wanted to know whether this founder of this particular method is a male or a female, right? Okay, fine. So that was a lighter note, but yes, that really happened. That really happened. That's why I'm sharing it. Fine. So now let's go to the next one, which is approach. So approach is called as Modigliani-Miller approach. Modigliani-Miller, yes, that same guy only. He asked me this doubt. Sir, Modigliani-Miller, is it one person or two people? Two people, pa. Okay, so two people. Two people put together. Modigliani is name of one guy. Miller is the name of another guy. Okay, if you want, you can research and Google it out and find out whatever is their full name and all. But I think this should be the surname of these two people. Then why two people came together? They gave this particular approach. I don't know. Maybe they did group studies, so they did the research together. Fine, but please let us just focus more on this particular area, because I was surprised when I was taking the core of this concept. All these doubts came in between. So that's why, if at all this has crossed your mind, let me be very clear on this. Let's not bother about all these people who have founded it. Basically, let's bother more about what they are actually saying. Modigliani-Miller approach, approach, popularly known as approach. This approach was given by two people, right? Modigliani-Miller in the year 1958, and it's very similar to NOI approach. Not similar, it is same. This guy has copied, these two guys have copied this. So Modigliani-Miller without tax is equal to net operating income approach. The second approach, what is that? Capital structure decisions are irrelevant. They're saying the advantage of a low cost debt will be offset by disadvantage in increase in equity, KE. That's what they are saying. So exactly, sir, not even a single thing is changed. No, every single thing line by line is the same. approach without tax is same as net operating income approach. Are you clear with this? As per this approach, capital structure decisions are irrelevant. As per this approach, the value of the firm and KO will remain constant. Yes, the same thing only. The value of the firm cannot be increased or decreased by changing the proportion of debt in the capital structure. This is exactly the same as your net operating income approach. Are you clear with this? Now, in this approach, they have given three propositions. Propositions means what? Propositions means their viewpoint. They have researched and they have come up with three different findings. What are these findings? We will see. Now, all these things is, this is nothing new. This was already found under NOI approach. Maybe they have done a lot of research and they have come up with, these propositions. They have come up with these propositions as such, but none of these are new. Every single thing is coming from your NOI approach. We will just see what it is. First proposition. The total value of the firm and KO remains constant. We know that. So value of the firm is equal to EBIT upon KO. Correct or not? Yes. Value of the firm is equal to EBIT by KO. We know this. Now what he's saying is value of levered firm is equal to value of unlevered firm. What is the meaning of this? He's saying levered firm means what? A firm that has some amount of debt in its capital structure. Unlevered firm means what? All equity firm. Now this method says just because you are infusing more debt in your capital structure, will your KO change? No. If your KO does not change, your value of the firm will not change. Yes, correct. The value will not change. Yes. So that's why he's saying the value of a levered firm is always equal to the value of unlevered firm. Or in other words, the value of firm is always the same irrespective of the source of your finance. That is the first proposition he's saying. As if we don't know this. We know this already, right? Yes. Proposition number 2. Proposition number 2. KE is equal to KO minus KD into debt upon equity. Sir, what a formula they have invented, sir. K is equal to KO plus KO plus KO minus KD into debt upon equity. This is nothing but, this is not a big formula and all. Don't think this is something else. Fine. I will just derive this formula in the next 2 minutes. Fine. Just see what this formula is. Now, proposition number 2. So now, just look at this. He's saying KE is equal to KO plus KO minus KD into debt upon equity. So this is what approach says in his proposition number 2. Nothing great, guys. Nothing great. We know the formula for KO. What do you mean by KO? Overall cost of capital. What is the formula for KO? So it is KE into WE, cost of equity into weight of equity, plus cost of debt into weight of debt. Correct, guys? Yes. Now, can I rewrite this as, so K into weight of equity is nothing but, can we say this is equity divided by equity plus debt, correct? That is equity divided by the total capital, and the total capital consists only of equity and debt. In this capital structure theory, I told you there is no preference, correct or not? Similarly, can we say KD is nothing but, KD into weight of D is nothing but debt upon equity plus debt, correct or not? Yes, we can rewrite it like this, or can we say KO is equal to, so the denominator is the same here, so KE into E plus KD into D, the whole divided by E plus D, correct or not? I'm just taking the denominator common, correct, guys? I'm just running through this quickly because this derivation is not required, but you should not feel that this is a separate formula. That's why I'm doing it here. So now cross multiply, so KO into E plus D is equal to KE into E plus KD into D, correct? Or can I say, keeping this in this side and taking this to the other side, can I say KE into E is equal to KO into E plus D minus KD into D? Yes, guys. Or if you take this E to the other side, can I say KE is equal to KO into E plus D minus KD into D, the whole divided by E, correct? This E goes to the other side, denominator, correct? Yes. Or if you further split it and write, can we write this as KE is equal to KO into E by E plus KO into D by E minus KD into D by E, correct? So KO into KE upon E, then KO into D upon E minus KD into D, correct or not? Here EE gets cancelled, correct? EE gets cancelled. So can I say KE is equal to KO plus KO into D by E minus KD into D by E, correct, guys? Yes. Or can we say this is nothing but, take this common, D upon E common, can I say KE is equal to KO plus debt by equity alone, you take it common, D by E into KO minus KD, right? And this is the formula that he has also given. This is nothing but mathematics, simple mathematics he has done, and he has just taken LHS to RHS and he has given the formula for KE. KE is equal to what? KO plus debt by equity upon KO minus KD. Look at this. That is what they have given. So KE is equal to KO plus KO minus KD into debt plus equity. Are you clear with this? This is nothing. You need not remember this directly also. This is nothing but what? That KO formula they have just rewritten and they have arrived at it. But this formula you need to remember for a reason. Because suppose if only these data around are given, with this also directly you can calculate KE. So for that it will be useful, but this is not a big invention and all in my opinion. Are you clear with this? We just derived this formula, so simple from this overall WACC, weighted average cost of capital. We derived this formula. So don't think Modigliani, Miller, they have given some new formulas and all they have invented. Maybe they have done some hypothesis, I don't know, but this formula is like plain mathematics. This has nothing to do with big invention. Clear with this? And the third one, the proportion 3, what they say is the structure of capital, that is financial leverage, the weight of debt does not affect the overall cost of capital. The cost of capital is affected only by business risk. So what they are saying is your finance risk is called as financial leverage. Your financial leverage or the proportion of debt and equity will never impact the firm. The firm's value is impacted only by its business operations. That is sales minus variable cost, contribution minus fixed cost is equal to profit. So only if there is a change in the operation side, costing side alone will impact the value of firm. The FM side will not impact the value of firm. So is it true? That is what Modigliani Miller is saying. Are you clear with this? Are you clear with this? This is what they are saying. And this proposition is exactly ditto same as what? This is ditto same as your NOI approach. See, as you increase the proportion of debt, KD will not change, KD will not change. Yes, your KO will also not change, but your KE alone will increase. Why KE increases? More the debt, more the risk, more the equity shareholders return expectation. Are you clear with this? And he's saying the advantage of low cost debt is getting offset by an exact increase in the KE, which actually knocks off and nullifies and makes the KO constant as a flat line. This is what NOI approach was saying. This is exactly what approach without tax is also saying. Are you clear with this, guys? Are you clear with this? So what are the three proportions? Could be a theory question. So the first approach is what? Value of levered. The first proportion says value of levered firm is equal to value of unlevered firm. Why? KO does not change. Simple. The second one is KE is equal to KO plus KO minus KD into debt upon equity. This is nothing but the reverse working formula of your KO formula, right? Weighted average cost of capital, WACC formula. Then proportion 3, what they are saying, yes, your the overall capital structure decisions are irrelevant. It does not impact the value of the firm. The value of the firm is impacted only by your business risk. This is what they are saying. Are you clear with this, guys? Just know what these things are. See, we know all these things logically. We saw, should you mug up anything, you can directly go. If there is a theory question, you can write it in an exam. If there is a practical question based on this, we'll be solving a few questions. You can just get complete control over it. Are you clear with this? Yes. Now, what does approach with tax says? Now, approach with tax. Now, what happened after a few years when tax and all were introduced in many countries? Now, these guys, Modigliani Miller, they said our approach is correct, but now in our approach, we are just making one extra addition. That is, we are going to adjust our approach for taxation. So, as per if tax rate is given, then the value of levered firm will be higher than the value of unlevered firm. So, he says the value of levered firm will be greater than the value of unlevered firm. Why? Because levered firm has something called as debt. Now that debt, yes, all these offset thing and all is fine, but for debt is actually a tax deductible expense. Interest on debt is a tax deductible expense. So tax will make your levered firm, that is a firm that has raised money from your debt channel, will actually be valued more because its overall cost of capital will be slightly lesser. Why? Because of the tax savings. Are you clear with this? So this approach with the tax says after a few years when tax got introduced, fine, what they started saying is, look, now because of tax, solely because of tax, not because of any other risk parameters, only because of tax, the value of a levered firm will always be greater than the value of unlevered firm. Why? Because now the value of levered firm will have a lesser cost of capital as compared to the value of unlevered firm. Unlevered means all equity. Levered firms means it has debt in its capital, some debt in its capital structure. So why is this happening? Lesser KO, more KO. Why lesser KO here? because of tax savings. Are you clear with this? Now he's slowly changing his proposition. Earlier he said value of a levered firm is equal to value of unlevered firm. Now he's saying value of a levered firm is equal to value of the unlevered firm plus the debt amount into tax. That is the amount raised from debt into tax rate. Are you clear with this? So what he's saying, value of a levered firm is equal to value of the unlevered firm plus debt rate into debt amount into tax rate. So what is the logic for this formula? Now this formula is also very logical. I don't want to spend time in proving this in the marathon session. So basically this is nothing but they have incorporated the concept of time value of money, right? It is derivation and all is not required for exam. So now if I do the derivation, it will take much more time. So in my regular batch, I do it and I show, so that people are convinced that actually this is a logical formula. So this is not something to be mugged up. But anyways, so you can just remember this formula because of constraint of time. So I'm just taking this up. Value of levered firm is what? Definitely more than value of unlevered firm. Fine. So value of unlevered firm. So value of levered firm is equal to value of unlevered firm plus the debt amount into tax rate. This is what approach with tax says. Are you clear? They have just changed that proportion 2 alone. They have just changed it and they have made it. So what does approach without tax says? Value of levered firm is equal to value of unlevered firm. What does approach with tax says? So here they are saying value of levered firm is equal to value of unlevered firm plus debt amount into tax rate. Are you clear with this? This is the story about all your capital structure theories. 4 capital structure theories. What did we see? Net operating income approach, net income, net operating income, traditional, and your approach. In without tax, with tax we've seen. Are you clear with this? So in this case, in the first case, net income approach, logical, things were logical. So as you keep increasing your proportion of debt in your capital structure, so KDKE will not change, but now since you are raising more funds through a cheaper source of finance, KO alone will fall down, correct? So capital structure decisions are relevant. This is what we saw here. The next one was NOI approach. He says, as you keep on increasing the proportion of debt in your capital structure, KD will not change, but KE will increase because more the risk, more the return expectation of the shareholders, and hence KE will change. But this advantage and disadvantage are exactly getting offset in such a way that your KO remains constant, unchanged. So basically, NOI approach says that your capital structure decisions are irrelevant to the value of the firm. Then traditional approach, what it says is it happens in 3 phases. Initial phase NI approach, then the second phase NOI approach, and the third phase everything will shoot up, everything will increase. Are you clear with this? And approach without tax, exactly the same of what NOI approach. With the tax, there is only one change. The proposition alone he has changed. What is he saying? Value of levered firm is equal to value of unlevered firm plus debt amount into tax. Are you clear with this? Into tax rate. With this, we have finished all the conceptual areas in this particular capital structure theories. Now let's dive into the questions and solve a few problems here. So please take the second question, which is question number 2. So now, let me read out the second question for you. Company P and Q are identical in all aspects, including the risk factors, except for debt and equity, right? So company P having issued 10% debentures of 18 lakhs, while company Q is unlevered. Now guys, learn the jargons. What do you mean by unlevered? So it doesn't have any debt in it, which means all equity company. Now, both the companies earn 20% before interest and taxes on the total assets of 30 lakhs, which means total capital employed is how much? 30 lakh rupees, on which both the companies are earning 20% as EBIT. I told you EBIT will not change because of your debt equity mix, correct? Because it's EBIT is something, but operating profit is not, it is not getting impacted because of your proportion of your capital structure. Next, assuming a tax rate of 50% and a capitalization rate of 15% from an all equity company. Capitalization rate means what? For an all equity company. So for the all equity company, the KE stands at how much? 15%. Now they are asking us to calculate the value of the companies P and Q using alternative number 1, net income approach, alternative number 2, net operating income approach. Okay, so this is what they are asking us. Now if you want, you can pause the question, you can pause the video once, read the question once again, and then you can continue. Right now, what is it that we need to do? What is given in this particular question? There are 2 companies that we have, company P, company Q, right? So equity, debt. So this is what we've got here, equity and debt, right? So now overall, the company has raised how much? 30 lakh rupees. Total assets they are giving. So in the absence of data, we'll say total asset is equal to the total capital that has been raised by the company. Now, company P, what they are saying is, it has issued 10% debentures worth about 18 lakhs, which means the balance 12 lakhs comes from the equity channel. Company Q is an unlevered company, which means zero from debt, which means all equity. The entire 30 lakhs was raised through what? The entire 30 lakhs was raised through the equity mode. Clear? Then they have also given one more thing for this company Q. Assuming a tax rate of 50% for both the companies, capitalization rate of 15% from an all equity company. So for the all equity company means what? The entire amount was raised from the equity channel, which means in this case, for this Q company, can I say KE is equal to KO? Why? Entire amount was raised only through the equity channel. So whatever is KE will be KO, correct? KO is equal to KE into 1 only. The entire weight is on the equity. Are you clear with this? So this is equal to how much? 15%. This is all they have given. This is the given data. With this, what they want you to find. Calculate the value of firm. You should find the value of firm for P and Q Limited for both the companies under the first part of the question says calculate the value of firm under net income approach. Second part says calculate the value under net operating income approach. Are you clear with this? Digest the facts. Now let us get started. Now, first, EBIT for the two companies. What will be the EBIT? So overall capital employed is how much? 30 lakhs. And they have said that EBIT is 20%. So 30 lakhs into 20%. How much is that going to be? 6 lakhs for P Limited, 6 lakhs for Q Limited. This will not change. I told you your capital structure will not impact your EBIT. Are you clear with this? Less interest. Now interest, it will be there only for P Limited. 10% debentures. So 10% on 18 lakhs. How much is that? It is going to be 1,80,000. For Q Limited, entire all equity, no interest at all. So what is my EBIT? Sorry, what is my EBT? 4,20,000 and 6 lakhs. Correct? Less tax at the rate of 50%. You reduce the 50% tax, you get what? Earnings after tax. Now, in this particular segment, there is no preference dividend. So obviously, your earnings after tax will be equal to earnings available to equity shareholders. Correct? Yes. Now, look at this. Look at what they are saying. Now, for this company, what they are saying. Now, first, we are following what approach? Guys, very, very, very important. This is where student approach this particular chapter without understanding the concepts. Net income approach. What does net income approach says? First approach, what they are saying. With increase in proportion of debt, what happens? KD will it change? No. KE will it change? No. KO alone changes. Correct or not? So if I increase my proportion of debt in my capital structure, so what happens? KD will not change, KE will not change, KO alone will change. Correct, guys? Yes. Now. Look at this, how beautifully we can interpret. They have given for the all equity entity, for Q Limited, KE is how much? KE is 15%. Guys, yes or not? Now, P and Q Limited are identical companies. The only change is their capital structure. Correct? Now, just because the capital structure change, under the net income approach, will KE change? No. In net income approach, what is the theory that they are saying? Your KE will remain constant. It will not change because of your capital structure. So can I say for P Limited also, the KE is 15%? Yes or no? How do we know? They have said Q Limited, the KE is how much? 15%. Now, under net income approach, they are saying KE will not change because of a change in capital structure. Correct? As you increase the proportion of debt, KE and all will not change. So the KE for both the companies will remain constant only because both are identical companies. The business risk and all is same. But because of financial aspects in net income approach says because of your financial factors, your KE will not change. That's what they are saying. Correct or not? So obviously this is what it is. Are you clear with this? So can I say this 15% is the KE capitalization rate for both the companies P Limited and Q Limited. Correct or not? Now earnings for equity. Correct? Divided by KE, can I say is the total value of equity? Yes or no? Earnings for equity divided by KE gives you the value of equity. Yes, guys. So here 2,10,000 divided by 15%. How much is it? Approximately it comes to. So 2,10,000 divided by 0.15. Yes, it comes to how much? 14 lakhs. So for this company, P Limited, the value of equity is how much? 14 lakhs. Yes. For Q Limited, what is the value of equity? 3 lakhs divided by 15%. It's going to be 20 lakhs. Correct or not? Yes. Now, what is the value of debt? For the first company, the value of debt is how much? 18 lakhs. For the second company, there is no debt. It's an all equity company. So, what is the overall value of the first firm? It is going to be value of equity plus value of debt. That was the first formula we saw. Correct? So, value of firm is equal to value of equity plus value of debt, and value of debt equity is how much? 14 lakhs. Value of debt is 18 lakhs. 14 plus 18 gives you 32. Whereas the second case is going to be 20 plus nil is going to be 20 lakhs. Are you clear with this? The key to this problem is what? The key to this problem is they have given the KE for Q Limited. Because we are following net income approach, you should know that the same is the KE for P Limited also. Why? Because KE will not change with a change in the capital structure. Who says this? Net income approach says this. So you should take here, and then what you need to do, earnings for equity divided by KE gives you value of equity, value of debt we already have, value of equity plus value of debt gives you the value of firm. As simple as that. Are you clear with this? Where is the problem in this case? Are you clear with this? Next. Net operating income they are asking. Now, guys, you should remember one thing. In net operating income approach that we saw, now, was there any taxes? We saw that in all the capital structure theories, there is no taxes, except in one case. Only in Modigliani Miller case, there was tax. Now, look at this. In this question, they have asked to compute the value of the firm under NOI approach. NOI approach is same as approach, correct or not? But in this question, there is also a tax rate, yes or no? So indirectly, look how beautifully they frame this question. This is not NOI approach. This is approach with the tax. Are you clear with this? This is how you should interpret this. This is approach with the tax. And look at this, approach with tax. So in approach with tax, so what is it that we've got? Now you tell me, approach with tax. Now, in this case, now, how do we go about with this sum? Now, for Q Limited, they have given that KE is equal to 15%. Yes or no? They have given KE is equal to 15%. Yes. So now, can we say that for this particular question, let's say under approach, that is basically net operating income approach they have asked, but since tax is that, we can clearly interpret that this is with tax. Are you clear with this? So, so can we say for the second company, P Limited, for that company only the data is given. Sorry, the Q Limited only data is given. Yes, for Q Limited, what happens? Tell me what is the EBIT minus interest gives you EBT minus tax gives you what? EAT, and this amount is also EFE. Correct? Yes. Now, divided by KE gives you what? Gives you the value of equity. Correct or not? Yes. Now, for this company, what is the EBIT? So, EBIT remains 30 lakhs into 20%. That will not change. 6 lakh rupees. Correct? 6 lakh rupees. Is there any interest here? No interest. So, which means EBIT is equal to EBT. This is also 6 lakh rupees. Correct? Now, what is the tax rate given in the question? The tax rate is 50% in this question, right? It's 50%. So, which means tax is going to be 3 lakh rupees. So, what's your earnings available to equity shareholders? 3 lakh rupees. Now, what is the capitalization rate? That is the KE rate that is given in the question. So, the KE rate given in the question is how much? 15%. So, 3 lakhs divided by 0.15. So, how much is it going to be? So, can we say that the value of Q Limited is 20 lakh rupees? Yes or no? The value of Q Limited is 20 lakh rupees. Yes or no? Fine. Or in other words, for this is what? Unlevered company. Correct? This is unlevered company. In case of an unlevered company, there is no interest. Or can I directly say the earnings for equity is EBIT into 1 minus T? Correct or not? Yes, because there is no interest. So can I directly calculate the EFE, earnings per equity, by saying earnings per equity is nothing but EBIT into 1 minus tax rate. Why? Because EBIT is equal to EBT. Because there is no interest. Are you clear with this? That is the reason why they have used this formula here. EBIT into 1 minus T divided by KO. So why KO? Because this is an unlevered entity, all equity entity. Correct? Yes. This KE is equal to KO. Correct or not? Because the entire source of finance is only KE. So for them, the overall cost of capital is only KE. Are you clear with this? You can also put KE, or if you want, you can put KO. Anyways, you will get the same thing. Are you clear with this? So you get the value of this unlevered firm. correct? Now recall this proposition. This is where I said you can use this formula. Value of levered firm is equal to value of unlevered firm plus the debt amount into tax rate. Yes, this was the proposition given under whom? Under approach with the tax. Are you clear with this? So we need to find out the value of value of the levered firm. Value of the levered firm is P limited. Value of the P limited is nothing but 20 lakhs, that is value of unlevered firm, plus debenture amount, debt amount is 18 lakhs into tax rate is 50%. He has given that formula. Yes, I told you this formula is nothing but this is time value of money concept and all. I told you let us accept this formula as such, but because the derivation is not required right now, this formula is a very logical formula, so don't worry about that. So now how much is this going to be? 20 lakhs plus 50% of 18 lakhs is going to be 9 lakhs. So it's going to be an overall value of 29 lakhs. So the value of the levered firm, that is P limited, is going to be 29 lakhs. The value of the unlevered firm, which is Q limited, is going to be how much? It's going to be 20 lakhs. Guys, are you clear with this? This is a very, very important understanding that you need to make in this. Somehow we have approached it. Are you clear with this? Yes. So the data was given for unlevered firm. With that, we calculated the value of the unlevered firm and we made use of that proposition. Value of the levered firm is equal to value of unlevered firm plus debt into tax rate. We used that and we calculated the value of both the firms. So under the net operating income approach with the tax, which is nothing but approach, net operating income is without tax only. So with the tax, they are asking indirectly, they mean the approach. So approach, we use this particular formula. Are you clear with this? This is how you need to approach this. Yes. So now let's go to the next question, which is question number 3. A Limited is expecting an EBIT of 3 lakh rupees. The company presently raised its entire fund requirements of 20 lakhs by issue of equity with an equity capitalization of 16%. So equity capitalization rate is nothing but KE. So the company is expecting an EBIT of 3 lakhs. It presently raised its entire capital of 20 lakhs from debt channel and the KE was 16%. The entire amount was raised from debt, the entire amount was raised from equity, yes, which means KE is equal to KO in this case, guys, correct or not? It's an unlevered entity. Yes. Now, the firm is now contemplating to redeem a part of its capital by introducing debt financing. The firm has two options to raise debt to the extent of 30% or 50% of the total funds. It is expected that for debt financing up to 30%, the rate of interest will be 10%. The equity rate is expected to increase to 17%. So now what they are saying, as you infuse more debt, KE will increase. That is what they are saying here. Look at this, KE will increase, right? Now, however, if the firm opts for 50% debt, then interest rate will be 12% and equity rate will be 20%. It will further increase. So look at what they have given. Yes. So now this looks like traditional approach. So they have given it in phases. Up to 30% debt. If you introduce debt up to 30% of your overall capital, that is 1 KE and KD. If it goes beyond certain level, then KE and KD also increases. You are required to compute the value of the firm and the overall cost of capital under the present situation and under the two different options if the traditional approach is held valid. Now what they are saying, currently the company has what? Currently the company has raised how much? 20 lakh rupees. Are you clear with this? Yes. Entire 20 lakhs is raised by what? Equity share capital. Now what they are saying, they want to introduce debt. How they want to introduce debt? They are saying we will buy back our equity shares. So how they are saying is buy back equity means what? They will pay their equity shareholders some money and buy back its own shares. Now for them to pay the equity shareholders money, how will they get it? They are raising, we will raise the funds through the debenture channel, the debt channel, or in other words, to this extent, equity will reduce and debt will come in. Now what they are saying is two alternatives. Alternative 1, introduce 30% debt. Alternative 2, introduce 50% debt. Are you clear with this? So 30% of 20 lakhs gives you 6 lakhs. So the balancing figure 14 lakhs will be equity. If you go for the other alternative, 50% debt, 50% equity, 10 and 10, this will be 20. Are you clear with this? The question is, now they have also given some changes and all. They have also given a few things. With this, we should say which is the best approach, which is the best alternative. The best alternative is the one that has the least KO and highest value of the firm, correct? But what they are saying here is, look, what they are saying here, KE, KD. right? Now look at this. KE is 16 percentage currently. 16 percentage currently, they don't have any debt. Now 16 percentage is the KE, right? They are saying if you raise debt up to 30 percentage, right? If you raise debt up to 30 percentage, the interest rate will be 10% and the equity rate will be 17%. Correct? So equity will be 17%, interest rate will be 10%. Are you clear with this? No tax is given in this question. Next. Now, if you want to raise debt for 50 percentage or more, the interest rate will increase to 12 percentage and even your KE will also increase to 20 percentage. So this will be 12 percentage, 12 percentage and 20 percentage. Are you clear with this? Clearly, this is a traditional model. See, beyond a point, what happens? KED also increases, KE also increases. Third phase is happening here. Are you clear with this? So they are asking us to calculate the value of the firm and the overall cost of capital under the present and the two different alternatives if traditional approaches are held valid, and suggest the best course of action. Now let's quickly do this. It's very simple. Guys. So what we need to do here, now look at this. So now first EBIT. What's your EBIT? Now EBIT is given 3 lakhs. Now will your EBIT change because of the capital structure? No. Why? It's an operating profit, basically, as simple as that. Correct? So now what is this going to be? 3 lakh, 3 lakh and 3 lakh. Less interest. Now you tell me. Interest. Now first alternative, is there any interest payout? No. All equity. Second alternative, yes. What is the interest payout? They are saying 6 lakhs is raised from debt channel. Correct? So 6 lakhs into 10 percentage, that is going to be 60,000. Are you clear with this? Because if your debt is up to 30 percentage of your overall capital, the interest rate is 10 percentage. Suppose if you are raising debt to the extent of 50 percentage of the capital, on the entire debt value, the cost, the KD, that is the interest cost, will be 12 percentage. So in the third alternative, it's going to be 10 lakhs into 12 percentage. That's going to be 1,20,000. Are you clear with this? So EBIT minus EBT, EBIT minus interest gives you what? EBT. 3 lakhs, 2 lakh 40 and 1,80,000. Are you clear with this? We got all these figures with us. Are you clear with this? Now what happens? Now just see what happens. Now minus tax. In this question, is there any tax? No. Nil. So you get what? Earnings after tax, or you can also call this as earnings available to equity shareholders. 3 lakh, 2 lakh 40,000 and 1,60,000. Now this is the earnings available to equity shareholders. Yes. Now, can we say the value of the firm is nothing but value of equity plus value of debt? Yes. Do we have the value of equity? Can we calculate the value of equity? Yes. How can you calculate the value of equity? Value of equity is nothing but earnings for equity divided by cost of equity. Yes or no? EFE divided by KE. Correct? EFE is how much? 3 lakhs. So 3 lakhs divided by what is your KE here? KE is going to be 16 percentage. Yes, it's going to be divided by 16 percentage. So calculate and tell me 3 lakhs divided by 0.16. It's going to be 18 lakh 75,000. This is the value of equity under the present proposal. In the second proposal, what will happen? 2.4 lakhs. It's earnings for equity divided by KE. What's the KE here? KE is now increased to 17 percentage, right? KE is now increased to 17 percentage. So it's going to be 2,40,000 divided by 0.17. It's going to be 14,11,764. For some reason, they have rounded it off to 14,12,000. So should we also round off? Not necessary. You can keep it as 14,11,764.7. You can keep it. Next. Finally, what is it going to be? Here it's going to be 1.8 lakhs divided by, I think finally the KE went up to 20 percentage, right? Divided by 20 percentage, you get how much? 1.8 lakhs, 1,80,000 by 0.2. So that gives you how much? That gives you, one sec. Yes, that gives you 9 lakh rupees. Yes, that gives you 9 lakh. This is the value of equity. Now, how do you calculate the value of debt? Very simple. Interest divided by KD. We saw all these formulas earlier. With logic, time value of money logic. I told you. Yes, look at this. I told you these formulas in the beginning. Value of equity is per share. If you want, you can say earnings per share upon KE, or overall if you want EFE by KE. Value of debt is nothing but total interest divided by KD. Yes or no, guys? Annual cash flow divided by discount rate. Yes. Fine. So now look at this. So that's how we need to do it here. So value of debt we can find out easily. Yes, value of debt we can find out easily. The value of debt is nothing but interest divided by KD. The interest divided by KD. Yes, so the interest divided by KD. So this is nothing but, one second. Yes, so this is nothing but what do we have here? So in the first phase, there is no interest only. So there is no value of debt, correct? In the second phase, it's going to be what? 60,000 divided by 60,000. So 60,000 divided by what is the interest rate, that is KD. What is the KD here? 10 percentage. So 60,000 divided by 10 percentage, it's going to be 6 lakhs. In the third phase, it's going to be what? I mean, third phase, as in the third alternative, it's going to be 1,20,000 divided by what? 1,20,000 divided by 12 percentage. 1,20,000 divided by 12 percentage, that gives you 10 lakhs. Are you clear with this? So what is the value of firm? Value of firm will be value of equity plus value of debt. So it is going to be 18,75,000 plus 0, which is 18,75,000. 14,12,000 plus 6 lakh, it's going to be 20,12,000. 9 lakhs plus 10 lakhs, it's going to be 19 lakhs. Are you clear with this? Now, can we calculate KO? Yes, we can calculate KO. So KO will be what? EBIT divided by value of firm, correct? EBIT divided by value of firm. So EBIT is what? Your 3 lakh rupees. Value of firm here, for each of the cases you have different values. So if you do that, you will get 16%, 14.9% and 15.78% respectively. Are you clear with this, guys? Sir, is there another way to calculate weighted average cost of firm? Yes. What is the formula that you can use? So KE into WE plus KD into WD. Are you clear with this? Now remember, if you use this formula, you will get a different cost of capital. Yes, you will get a different cost of capital. That the reason is because of the capital structure theory assumption. Here, what assumption? We make no taxes and all these things divided by value of firm. That's what we do. But there in weighted average cost of capital, we take the respective cost of the respective weight. So if you do it under this approach, that is the weighted the cost of capital WACC approach, obviously the answers that you will get for each of these three will be different. Don't worry about it. Sir, then how will we know which one to follow? Simple. In exam, if this question comes, if a question comes in capital structure theory, in capital structure theories, then you can use this formula. Your weighted average cost of capital is EBIT upon value of firm, and I gave you the logic as well. Are you clear with this? So with this, we have comprehensively seen all the methods and we have learned all the approaches of capital structure theories. Important, a very important chapter from an examination perspective. Maybe who knows, this could even be tested for 10 marks. These questions are 6 plus 4, 5 plus 5, whatever combination they could test it. But basically this chapter, the most important part is the tricky part, is basically in your capital structure theories. There are 4 capital structure theories broadly: your net income approach, net operating income approach, traditional approach, and approach. Approach with and without tax, approach with tax. Approach without tax is same as your NOI approach. Approach with tax is actually the only difference is value of levered firm is equal to value of unlevered firm plus debt amount into tax rate. That's the only difference. Are you clear with this? So with this, we have completely revised in detail this entire chapter. So have complete control over this, practice many problems. So with this, we are done with this particular chapter. So now we will move to the next one.